AI was supposed to kick off a white-collar purge, but the reality is different. In Fortune 500 boardrooms across the country, thousands of AI agents are being shut down, not because they didn't work, but because they're a legal time bomb. The narrative is that tech giants are spending everything to win an AI arms race, but the reality is much messier. They're stripping the liability out of their systems while pouring billions into the build-out. And when the dust settles, someone still has to pay for it. The U.S. interstate highway system is 48,000 miles long. It took 35 years to build and cost $630 billion in today's money. It is, by any measure, one of the most consequential infrastructure investments in human history. Meanwhile, big tech is spending $725 billion in 2026 on AI infrastructure alone. That number has more than doubled in just 2 years and is projected to keep climbing into the trillions by 2030. In fact, Goldman Sachs now estimates that the total AI infrastructure bill between now and 2031 will exceed $7.61 trillion. For that kind of money, you'd expect a revolution. What these companies are getting right now is cents on the dollar. The entire global AI services market in 2025 generated around $25 billion against hundreds of billions of infrastructure spending. When a Chinese startup called DeepSeek revealed in January 2025 that it had built a competitive AI model using Nvidia's lower-end chips for under $6 million, it seemed almost impossible, but it still shook the market, wiping out around $590 billion from Nvidia's market cap in a single day. It was the largest single-day loss in U.S. stock market history. DeepSeek, far from breaking AI, merely raised the question every investor had asked himself: what exactly are we paying for? The companies spending this money don't just have it lying around, they are borrowing it. Well, Alphabet quadrupled its long-term debt in 2025 to $46.5 billion. The five biggest tech companies issued $108 billion in new bonds last year alone. Bank of America now estimates that AI CapEx now consumes 95% of operating cash flows after dividends. Amazon is projecting a 95% decline in free cash flow thanks to its AI build-out costs. They are, in essence, mortgaging their present against a future that hasn't shown up yet. The gamble is genuinely alarming. If it were startups chasing hype, that would be one thing. These are the most sophisticated capital allocators on the earth. When they spend like this, they either know something the rest of us don't, or they're caught up in something they can't stop without admitting they were wrong. Either way, something has broken. To understand what, you have to go back to the moment a grieving man in Vancouver asked an airline chatbot a simple question and changed corporate legal history forever. On the day his grandmother died, Jake Moffat opened his laptop and went to Air Canada's website to book a flight from Vancouver to Toronto. He had one question: did the airline offer bereavement fares, and could he apply for one after the fact? He asked the chatbot and it said yes. It told him to submit his request within 90 days of purchase and the discount would be retroactively applied. So Moffat booked the ticket, flew to Toronto, came home, and then filed the request like he'd been told. And Air Canada denied it. Their actual policy, as it turns out, required bereavement fare requests to be made before travel. The AI chatbot had simply made up a policy that didn't exist, stated it with complete confidence, and sent a grieving man to buy a full-price ticket based on a lie. So Moffat sued. And what happened next is the reason every corporate lawyer in America now has an opinion about chatbots. Air Canada's legal defense was interesting. They argued it could not be held liable for information provided by its chatbot because the chatbot was, quote, a separate legal entity responsible for its own actions. They had deployed a piece of software to represent their company, and when that software caused harm, their position was essentially, don't look at us. Tribunal member Christopher Rivers was not impressed. While a chatbot has an interactive component, he wrote, it is still just a part of Air Canada's website. It should be obvious to Air Canada that it is responsible for all the information on its website. It makes no difference whether the information comes from a static page or a chatbot. Air Canada was ordered to pay $812 Canadian, and in perspective, that amount is trivial. The precedent was not. That ruling landed in February 2024. What followed was a corporate panic that never made headlines, but could be seen in the risk sections of SEC filings. In 2020, 4% of public companies mentioned AI as a material risk in their annual filings. By 2024, that number was 43%. Among the Fortune 500 specifically, 56% now lists AI as a formal risk factor. Among media and entertainment companies, it's 92%. The SEC itself has been sending enforcement letters demanding more specific disclosures, backed by $8.2 billion in financial remedies in the year 2024 alone. Climate change took decades to achieve similar disclosure penetration across corporate America. AI did it in 3 years. What the Air Canada ruling established is that whatever your AI says to a customer, you said it. You can't outsource the liability to the software you employ. You can't just point at the machine and then look innocent. You are the machine. For a technology that can't guarantee it won't make things up, that ruling created an absolute certainty. Deploy AI at scale, and eventually liability follows. The bigger question is, will there be anyone left to cover the bill? In July 2024, research and advisory firm Gartner predicted that at least 30% of enterprise Gen AI projects would be abandoned after proof of concept by the end of 2025. By April 2026, they had to revise their original estimate. It turns out that it was actually more like 40% of enterprise AI projects launched in the previous 2 years that would be scrapped before they ever shipped. Separately, Gartner now predicts that over 40% of agentic AI projects, the next generation of AI tools companies are currently betting on, will be canceled by the end of 2027. The graveyard keeps growing. S&P Global Market Intelligence put some finer numbers on it. The average organization scrapped 46% of AI proof of concepts before reaching production. Of the projects initiated, only 48% make it to production, with an average of 8 months between prototype and launch. That is 8 months of engineering hours, infrastructure costs, and executive attention on a coin flip chance of shipping anything at the end of it. McKinsey, another consulting firm, surveyed organizations globally in late 2025, and they found that 88% use AI in at least one business function. If that sounds like a success story, it's not. Only 39% reported any measurable impact on earnings. At most, 61% reported no meaningful financial impact on their business whatsoever. Roughly 6 in 10 companies have plugged AI into their operations and can't point to a measurable return it's made them. The reasons are familiar enough that Gartner has named them outright: poor data quality, weak risk controls, rising costs, and unclear business value. Each project costs between $5 and $20 million to build and deploy. Multiply that across thousands of Fortune 500 initiatives, and you're looking at tens of billions of dollars buried in the corporate graveyard. It gets even worse for big tech. A 2024 Deloitte survey found that 47% of enterprise AI users admitted to making at least one major business decision based on the content AI had simply invented. In other words, nearly half had already trusted hallucination with real-world consequences. Granted, things have evolved a lot since 2024. The efficiency revolution is still an aspirational possibility as agentic AI improves. But you wouldn't be human if you hadn't wondered why the flaws you've seen firsthand seem absent from the market's calculations. There's a particular breed of corporate fear that shows up where you would least expect it: insurance contracts. Basically, if the people whose entire business model depends on their ability to correctly price risk deem something uninsurable, that is usually a huge red flag. In January 2026, the Insurance Services Office introduced new exclusions targeting generative AI. Essentially, if generative AI causes the damage, don't assume you're covered. New policy language began excluding claims tied to AI-generated text, images, audio, video, and code. That is every large language model ever built. The chatbots, the AI copilots, the autonomous agents, all of them circled with black ink and excluded from the policies that cover 82% of U.S. businesses. In 2024 and 25, insurers had been narrowing AI coverage in existing policies by tightening up language and adding exclusions. W.R. Berkley introduced an absolute AI exclusion across directors and officers, errors and omissions, and fiduciary liability lines. AIG saw that and they said, well, we'll have more of the same. Great American Insurance followed. Chubb, Travelers, Berkshire Hathaway received state regulatory approval for their own exclusions. State regulators have been approving more than 80% of those requests. The industry has seen this movie before. A decade ago, cyber insurance went through an identical cycle. There was invisible coverage until claims mounted, and then came the exclusions. Eventually, standalone products emerged at premiums most companies couldn't stomach. The AI liability market is speed-running the same cycle. Insurance companies are not moral actors. They do not exclude things because they find them distasteful. They exclude them because the numbers don't work. They tried to price in AI liability throughout 2024 and 2025, and 42% of insurers reported tracking no AI risk metrics at all. When you can't measure risk, you can't price it. And when you can't price it, you exclude it. The legal system said, whatever your AI does, you did it. The insurance industry said, and we won't be covering that, which left every company still running public-facing AI deployment holding the entire liability themselves, all on hardware that was simultaneously losing most of its value. In the summer of 2023, if you wanted to rent a single Nvidia H100 GPU, a foundational chip in the inception of the AI arms race, you were paying between $7 and $10 an hour. To buy one outright on the secondary market, you were looking at $40,000 to $50,000 per card. Startups were putting H100s on their balance sheets like assets, and venture capitalists were asking portfolio companies how many they had on their books. Nvidia's market cap soon passed the $1 trillion threshold, and it kept rising. In February 2026, it hit $5 trillion. The H100 was, for a brief, dizzying moment, the most strategically valuable piece of hardware on the earth. Today, you can rent one for $2 an hour. In June 2025, AWS cut H100 pricing by 45% overnight. The secondary market collapsed right behind it. GPUs that had sold for as much as $50,000 during the AI boom were suddenly worth less than half that. Entire H100 server systems that once cost more than $350,000 were now trading for a fraction of their peak value. Over 300 new GPU cloud providers entered the market in 2025 alone, all of them selling capacity that nobody was buying at the rate anyone projected. Thousands of companies weighing up where to sell the cards at a loss. It is the difference between making payroll and not making payroll. This signals a deeper problem about the infrastructure thesis that justified the entire build-out. The argument was always that compute was scarce, that scarcity created value, and whoever controlled the most compute would win out in the AI race. DeepSeek fractured that argument by building a model competitive with GPT-4 on a budget that Meta spends on catering. The telecom industry learned the lesson the hard way in the late 1990s, when companies invested more than $500 billion in fiber optic cables based on projections of a 1,000% annual internet traffic growth. When monetization stalled, the debt markets closed. Miles of fiber sat dark for years, owned by companies that no longer existed. The asset had been real, but the business model built on top of it had not. No amount of Google fiber buildouts by the 2010s could fix that. The H100 fire sale is the fiber glut of 2025. The hardware is real, the revenue was supposed to follow. It hasn't. Today, the trillion-dollar companies watching their hardware depreciate have made a calculated decision on what to do with their cash instead. There's a move corporations make when they believe their own stock is a better investment than their future. They take their cash and they use it to buy back their own shares. This reduces the number of shares in circulation, boosting earnings per share, which then lifts the stock price. Investors love it. Boards love it. Everyone wins. Yet it is a signal that the smartest people in the room looked at every opportunity available and they chose not to bet on the future. Instead, they bet on the thing already making money today. Over the last 5 years, the companies loudest about the AI revolution have been doing exactly this at a scale that is difficult to fully absorb. Alphabet has spent about $280 billion buying back its own stock. Meta and Microsoft have spent tens of billions. Apple, which barely talked about AI until recently, has spent $704 billion buying back its own stock over the past decade. That's more than the entire market value of 488 companies in the S&P 500. And then the data center bills started piling up. All of the money disappeared. In September 2024, Microsoft promised shareholders a $60 billion buyback program. It signaled that the company was flush, confident, and committed to returning cash to the people who owned it. A year later, $57.3 billion of that promise still sits completely untouched. Microsoft didn't change its mind, but every spare dollar was getting redirected into paying for servers, data centers, and AI infrastructure instead. In other words, they wrote the check, they just couldn't afford to cash it. This is what the AI arms race really looks like from the inside. The story being sold is one of a confident sprint into the future. The reality is a scramble to fund it. Companies are being squeezed between investor expectations and the soaring cost of AI infrastructure. For Microsoft, that's led to a $60 billion commitment sitting on the books like an IOU that nobody can collect. Alphabet's free cash flow is projected to plummet almost 90% in 2026, from $73.7 billion down to $8.2 billion. And in 2025, Alphabet, Amazon, Oracle, Meta, and Microsoft issued $121 billion in new debt via bonds to keep the lights on. That is 4 times what the entire tech industry borrowed on average in any year of the previous decade. The AI revolution is being funded on credit, not profits. And the org charts that were supposed to prove this was working have started to change. At some point in 2023, someone in a corporate communications department typed the words generative AI into a press release and felt genuinely excited about their job. The phrase had some weight. It had mystery. It implied that the machine was creating something, thinking almost, generating. The word did a lot of heavy lifting for a lot of companies that had no idea what they were actually going to do with the technology. By 2026, the impetus for generative AI has turned into agentic workflows. People are talking about autonomous process orchestration and intelligent automation. It's the exact same technology, but the promises for what it can deliver are dramatically smaller. Today, the gap between the language of 2023 and the language of 2026 tells you almost everything you need to know about what happened in between. The conversation has shifted from possibility to proof, from what could this do to what did it actually deliver. The companies that survived the graveyard of AI project rollouts did so by making their AI projects smaller, narrower, and harder to sue over. Not by funneling all their cash into chatbots that could answer any question, or AI that writes company strategy well. What this means is a lot of routing software that sends customer service tickets to the right department and AI that scans contracts for non-standard clauses, things that are dull, specific, and measurable. Things that are wrong in ways that humans can still catch before they get expensive. And the job titles reflect that. In 2025, 26% of organizations had a Chief AI Officer or CAIO. By 2026, that number jumped to 76%, tripling in a single year, according to an IBM study of 2,000 CEOs across 33 countries. But read the fine print on what those CAIOs are actually being hired to do, and it is obvious the role has fundamentally changed. It used to be AI evangelists promoting the technology. Now it's executives responsible for things like risk management, regulatory compliance, and governance. The EU AI Act kicks in fully in August 2026, requiring companies to identify exactly who is accountable when their AI causes harm. The CAIO is increasingly the person whose name goes on that form. Probably not the job description anyone imagined when they coined the title, but here we are. Meanwhile, the outcome of the earnings calls has quietly shifted too. AI-powered is out. Outcome-focused workflows is in, which is, if you read it slowly enough, a very expensive way of saying that the AI does a specific task and you can measure whether it worked or not. The dream that produced the $725 billion build-out was always something closer to science fiction. AI that could run an entire department, write strategy, replace an entire team, or what have you. CAIOs with compliance checklists and the EU AI Act obligations are now doing work that would have been unrecognizable to the people who wrote the original press releases. The revolution got a job in middle management. And the reason it ended up there is something the industry has been trying to explain away since the beginning. Back in 2023, when ChatGPT was still a twinkle in many people's eyes, attorneys Stephen Schwartz and Peter Loduca filed a legal brief in the Southern District of New York. The brief cited very real-sounding cases with very real-sounding names and very real-sounding outcomes as precedent. Varghese v. China Southern Airlines, Martinez v. Delta Airlines, and Shaboon v. Egypt Air. And then Judge P. Kevin Castle looked them up and none of them existed. ChatGPT had invented every single one, with absolute confidence. Schwartz and Loduca were sanctioned, publicly humiliated, and their names are now permanently attached to one of the most cautionary legal filings in American judicial history, Mata v. Avianca. That was in 2023. Things didn't improve. In August 2025, U.S. District Judge Alison Bacchus sanctioned a lawyer whose brief contained 12 fabricated or unsupported citations out of 19. The California court ordered 2 law firms to pay just over $31,000 in fees for filing what the judge described as bogus AI-generated research. In February 2025, 3 lawyers from the national firm Morgan & Morgan were sanctioned for the same thing. There are now over 1,600 documented cases involving AI-generated hallucinations, with 79% of lawyers reporting that they use AI tools internally in their practice. Why does this keep happening? Why hasn't it been fixed? Well, because it can't be. Large language models are actually very poor at looking things up. They're not attuned to retrieving facts from specific databases and handing them to you on a platter. Rather, their entire mechanism start to finish is to predict the next most statistically likely word based on patterns learned from training data. That's it. When the output stops being true, there's no internal alarm klaxons that start blaring. It's rare that your local LLM will humble itself enough to admit that it's actually not really too sure about that fact or how it even got there logically. The model will generate whatever continuation sounds most plausible. Sometimes that is perfectly accurate. Sometimes it's Varghese v. China Southern Airlines, a case that doesn't exist, described in convincing detail to a federal judge. In 2025, OpenAI researchers proved this. Their conclusion was that LLM hallucinations were such a big part of how these systems generate text that they had become mathematically inevitable. The same predictive mechanism that makes them useful is the same mechanism that makes them lie. You can't have one without the other. The numbers are not flattering. A 2026 benchmark across 37 models found hallucination rates ranging from 15% to 52%. Those are the best models money can buy. The single most reliable one still gets it wrong 1 time in 7. Stanford found rates between 58% and 88% in legal queries specifically. In medical case summaries, 64% hallucinate without mitigation. The industry average across leading models sits around 22%. That means the AI your company deployed to talk to customers is confidently wrong 1 out of every 5 interactions. Some newer reasoning models hallucinate more than older ones. The technology is not converging on zero, it is converging on less catastrophically bad than before, which is a very different thing. A human employee who got their facts wrong at these rates would not survive their first week at a job. The fact that these systems were deployed to millions of people simultaneously should raise another obvious question. If this is the technology, who on earth is actually making money from it? While the Fortune 500 was busy canceling chatbots, a firm called Jane Street posted $39.6 billion in net trading revenue in 2025. That is more than Goldman Sachs. It's more than JP Morgan's entire trading operation, and all of that was generated by roughly 3,000 people working across 4 offices using AI systems. In Q2 2025 alone, Jane Street made $10.1 billion. It was a record for any trading firm in history. For comparison, Citadel Securities posted $12.2 billion for the full year, a 25% increase over 2024. Hudson River Trading posted $12.3 billion. These firms combined to handle more than half of the captured market-making revenue in quantitative trading globally. They are, by any measure, the most profitable AI operations on Earth. The reason you haven't heard much about them in the AI debate is simple. Their systems aren't writing emails or answering customer service tickets. They execute trades in microseconds across $2 trillion in monthly equity volume. In that world, the data is so clean and feedback is so immediate that a hallucination is instantly exposed as an expensive mistake. The compute is the same, the feedback loop isn't. When Jane Street's AI is wrong, the market tells it immediately and charges it money for the error. Forget 90-day grace periods while customers file a legal complaint. There is absolutely no tribunal ruling on whether the output was misleading in the first place. Wrong is financial loss, potentially financial ruin for some, which triggers instant retraining. The system improves because it can't afford not to. The winners of the AI revolution so far are companies that have found problems where wrong answers are caught fast, cost real money, and force immediate correction. These AI models have something that the enterprise chatbots don't: a brutally honest referee. The companies without it are the ones staring at empty data centers and unpaid energy bills. And the bill in 2026 is coming due. CoreWeave is, depending on who you ask, either the most important AI infrastructure company in America or the most instructive cautionary tale. It grew from $16 million in revenue in 2022 to $1.9 billion in 2024. It owns and operates the GPU clusters that power a significant chunk of the AI build-out. It also has $24.5 billion in total debt, $7.5 billion in interest payments due by the end of 2026. 62% of its revenue comes from a single customer, Microsoft. That same Microsoft that just told shareholders its free cash flow is collapsing, and its $60 billion buyback program is sitting untouched because it can't afford to execute it. That is undoubtedly a very expensive gamble on one relationship. The AI data center build-out is starting to look familiar to financial historians, just like the telecom boom that ended with dark fiber in 2001 and $2 trillion in market value wiped out in 2 years. The infrastructure was real, the revenue never showed up. Now the ground is shifting again. Investor Michael Burry, the man who predicted the 2008 financial crash, has argued that hyperscalers are depreciating Nvidia's chips over 5 to 6 years. That is, despite their economic life being closer to 2 or 3. He puts the understated depreciation across the industry at roughly $176 billion through 2028. Meanwhile, Chinese AI labs are closing the performance gap with American frontier models in weeks at a fraction of the cost. A new open-weight model from China can trade blows with GPT-5 on engineering benchmarks at 1/6 the price per token. Intelligence is getting cheaper faster than the infrastructure built to sell it can depreciate. Roughly half of US data centers planned for 2026 are already facing delay or cancellation. And now Nvidia has released a desktop computer, the DGX Spark, that costs $4,700. It sits next to your monitor and it runs models that just 2 years ago required an entire server room. If that level of compute can sit on a desk, the demand for billion-dollar data centers doesn't have to collapse. It just has to grow slower than investors were promised. And that gap between projection and reality is what turned $725 billion of infrastructure into a very expensive mistake. And now everyone can see it. It seems like the AI revolution isn't living up to its hype. In fact, it may be worse. We're told that AI is a brand new technology led by a generation of geniuses. But what if it's not new at all? What if we've seen this exact story before? Because behind the hype, the same billionaire class that rode the dot-com bubble of 1999 is back, just under a different name. Money is pouring in early, long before anyone knows where the peak really is, because no one wants to miss out. And through this hype, one phrase keeps getting repeated like a mantra. This time, it's different. Except, it's not. And it's you that'll be left to pick up the tab. The dot-com bubble promised global connectivity. Instead, it drained $5 trillion out of the NASDAQ between March 20th and October 2002. Ordinary Americans bore the brunt of that. Retirement accounts loaded up with internet stocks lost about 78% of their value over 2.5 years. A Vanguard study found that by the end of 2002, millions of 401k accounts had lost at least 20% of their value. Heavily tech-exposed portfolios were hit even harder. Across the country, tens of millions of American workers were left holding the bag. These were the people who pulled cash out of their homes to chase Pets.com and Webvan and then got margin calls instead of returns. Foreclosures followed, destroying lives all across the country. Most of them never made the news. The NASDAQ peaked at just over 5,000 on March 10, 2000, and then the crash happened and it plummeted to around 1,000. Once you account for inflation, it didn't get back to the peak level until 2018. That is 18 years of lost growth for the people who clung to the dot-com bubble. And now we're staring down the barrel of the same gun. Big tech spending on AI data centers and chips is now over $300 billion a year. The value piled on top of that spending sits in fewer hands than at any time since the dot-com years. Most people assume that this is a brand new cast of characters. It is not. The AI movement is framed as a fresh rebellion led by hoodie-wearing newcomers in San Francisco. The people setting the pace today are mostly the same people who set the pace last time. Only they have 25 more years of contacts, government access, and investors lined up behind them. During the original mania, Reid Hoffman made his fortune through PayPal. Now he's an early backer and former board member of OpenAI. Vinod Khosla rode his Sun Microsystems stake through the late 1990s hardware wave. He followed Hoffman into OpenAI. Mark Andreessen built Netscape and took it public at 24 years old in August 1995. That IPO is what most people see as the official starting point of the dot-com era. Today, he runs the venture firm Andreessen Horowitz, which has poured billions into the current crop of AI labs. What looks like a technological revolution may be something closer to a very expensive piece of theater. And the same fingerprints keep showing up at every stage. When big tech promised the internet would erase distance forever, it felt like a defining moment in history. Money poured into anything with .com in the name. Between 1995 and the March 2000 peak, the NASDAQ exploded roughly 400%. Investors stopped asking whether the companies made money. Revenue barely mattered. Profit was considered outdated. The only thing Wall Street cared about was speed. They wanted to grow and attract customers. They wanted to dominate the sector. The business model and logistics could come later. And then came the crash. Now the AI explosion is reviving that same energy with just smarter machines instead of websites. Massive data centers are burning through electricity to train models that get more powerful every month. And again, nearly all the money is flooding into a select group of companies. The biggest winner so far is Nvidia. Every serious AI company needs its chips. That demand pushed Nvidia's valuation into territory that would have sounded insane just a few years ago. By 2024, investors were throwing money at Nvidia the same way they were once plying it into internet stocks before the dot-com crash. It's not quite as extreme as Cisco at the peak of the dot-com bubble, but it is moving in a direction that feels very familiar. The cash this time is coming mostly from big tech's own bank accounts, not solely venture capital, but it all ends up in the same place. Every bubble sounds good while it's inflating, but which one is the ultimate trap? To understand that, we need to look at the various factors that shaped the bubbles. In 1999, Cisco Systems owned 72% of the enterprise routing and switching market. That means Cisco sold the physical boxes that made the internet work. It was selling the backbone of the internet itself. Every company rushing online needed Cisco's hardware, and the money pouring in proved it. By fiscal year 2000, Cisco was generating nearly $18.9 billion in annual revenue. On March 27, 2000, Cisco hit $80 a share. Its market value surged past $555 billion. For a brief moment, Cisco became the most valuable company on earth, overtaking Microsoft. Investors weren't just buying into a successful company. At its peak, Cisco traded at a price-to-earnings or PE ratio of 201. Imagine paying $100 for a lemonade stand that only earns you $1.25 a year. The stand might be incredible, but the numbers border on fantasy. The whole thing rested on venture capital continuing to flow to the startups buying the routers. When that funding froze in the spring of 2000, the orders dried up. Cisco couldn't handle it. The stock fell about 80% from its peak over the next 30 months. It took Cisco almost 26 years to climb back to that $80 mark. The recovery hit in December 2025. Anyone who bought at the top and held it all the way still lost more than half of what their money could buy. Inflation ate the rest. Nvidia in 2024 looks eerily similar to Cisco at the peak of the dot-com era. Its chips are shipped by the truckload. Data centers across the world are stuffing racks with Nvidia GPUs as fast as they can get them. The demand looks unstoppable, but the reality is a lot more fragile. Many of Nvidia's biggest customers are AI labs and startups burning through investor cash at historic speeds. The rest are tech giants spending billions because they believe AI has to work, not because the profits already exist. That's the part that makes veteran investors nervous. When analysts overlay Nvidia's 2024 valuation surge against Cisco's climb before the 2000 crash, the curves follow the same trajectory. When two bubbles separated by 25 years begin drawing the same shape, people who lived through the first one tend to pay attention. Most people assume Nvidia is safe because, unlike the dot-com flameouts, it has real hardware revenue. But Cisco had real hardware revenue and a dominant market share. The 2000 crash didn't come because the router stopped working. It came because the people writing the checks ran out of money. Cisco's peak was actually sharper than anything Nvidia's touched so far. It should be a warning. The number tells you just how much further the current cycle could still inflate before that same demand cliff shows up. So the machinery looks familiar, but the more revealing comparison is the people making the decisions behind it. During the late 1990s, executives at the biggest tech companies kept telling investors the same story. The internet had changed everything. The old rules about profits and valuation no longer applied. Earnings would eventually catch up to the hype. Meanwhile, behind the scenes, insiders were selling stock. They were small sales, just enough to avoid setting off alarms. At the time, almost nobody paid attention. It only became suspicious years later after the bubble burst and someone looked closer. The numbers, when they finally came out, were ugly. Between September 1999 and July 2000, dot-com insiders cashed out $43 billion of their own company stock. That was twice the rate they had been selling at in 1997 and 1998. February 2024 was a different animal. The camouflage came off. In a single 9-day window that month, Jeff Bezos sold $8.5 billion of Amazon stock. The Walton Family Trust dumped $1.5 billion of Walmart shares over that same stretch. Jamie Dimon, the CEO of JP Morgan, sold $150 million of his own bank's stock. That was his first sale in 18 years on the job. Leon Black, the Apollo co-founder, unloaded $172.8 million, his first sale ever. The combined number for that 1 month came to $11 billion. But it didn't stop there. Mark Zuckerberg offloaded roughly $2 billion of Meta stock across the 4 months heading into that window. One at a time, the moves all looked normal. They were nothing out of the ordinary, but stacked side by side, the people closest to the numbers were cashing out at the same moment. The whole time, public messaging from those same executives stayed bullish, belief in the project. Publicly, they talked about decade-long opportunities and the future of AI. Privately, they were cashing out near the highs. The interviews said confidence. The filings said, take the money. Fortune ran the headline, The Great Cash Out, on February 27, 2024. It was a fitting title. When the people closest to the boom started taking money off the table, it usually means they understand the risks better than everyone else. And unlike 1999, the selling is happening faster and in larger amounts. The people building the boom increasingly look like the people preparing to survive the end of it. But if insiders are selling, who is still buying enough stock to keep prices floating at these levels? In 1999, Webvan built refrigerated warehouses for customers who didn't exist yet. Pets.com made television commercials that turned out to be more memorable than its actual orders. Both companies poured cash into buildings, trucks, and ad campaigns shaped around demand that never showed up. Both became case studies in burning money because neither made it to its second birthday on the public markets. Stability AI is the modern version of those companies. In 2023, it spent roughly $99 million renting compute power from AWS, Google Cloud, and CoreWeave. On top of that, another $54 million went to salaries and running costs. Their total revenue for the year, $11 million. That's a burn-to-revenue ratio north of 14-1. By July 2023, Stability AI was already short on its AWS bill by $1 million. Internal reporting later showed the company had no real plan to pay the $7 million August invoice either. But the cash didn't vanish into a black hole. It moved on a specific traceable route. Venture firms wired fresh capital into AI startups. The startups turned around and handed that capital straight to Nvidia for chips and to Microsoft Azure for cloud time. Big tech then booked that spend as their own revenue, pushing their stock prices higher. The higher stock prices justified bigger venture commitments, and the next round of money flowed right back through that same pipe. It's what people inside the industry call the circular economy. It might be the single most important trick in the current boom. A dollar leaves a Silicon Valley account and lands in some AI startup's bank account. But it doesn't sit there for long. Within a few weeks, that same dollar usually shows up on Jensen Huang's earning call as growth, and then it helps push Nvidia's stock higher. That makes the next venture fund easier to raise. Then another dollar gets sent through the same loop. Most of the money isn't coming from everyday customers buying AI tools because they can't live without them yet. Sure, companies like OpenAI have concrete revenue, but a large part of the money doesn't measure how many people actually use the products. It's measuring the same pool of capital moving back and forth between 5 connected companies. A good example is Inflection AI. In June 2023, it raised about $1.3 billion at a valuation of roughly $4 billion. The investor list read like a who's who of the AI boom: Microsoft, Nvidia, Bill Gates, Eric Schmidt, Reid Hoffman. Then less than a year later, in March 2024, Microsoft effectively absorbed the company. It paid around $650 million, hired most of the team, and licensed the core technology. Inflection as a standalone business was finished. The investors, though, walked away with 1.5 times what they'd put in. The cash had already passed through Nvidia's order book and Microsoft's cloud invoices on the way down. The only people who lost out were the late buyers. The speed and design of this cash loop go way past anything the dot-com failures pulled off. Webvan was sloppy in a way the market eventually figured out. What's happening around AI feels different. It's more coordinated, it's less of an accident and more of a system. So who benefits while it works, and who is left holding the losses when it stops? In 1999, day traders opened online brokerage accounts for the first time and rushed into anything that was moving. They were snapping up things like IPOs and internet stocks. Many were buying on margin or borrowed money, so every rise felt amplified. At the same time, the biggest institutions were backing off, but the market didn't fall immediately. It kept going because there was still someone willing to buy at higher prices. That someone was the retail traders. Except they didn't know that. They just saw rising charts and they didn't want to miss out. Instead, they were absorbing the market. The 2024 version is worse. Trading wasn't just about buying and holding stocks anymore. A huge share of activity was people making bets that expired the very same day they were placed. Cboe Global Markets reported that this kind of ultra-short trading became so common it was approaching half of all activity tied to the S&P 500 options market on typical days. Even the 2021 meme stock frenzy didn't reach that level. The market was being gamed in real time, minute by minute. Robinhood spent 2023 and 24 running television ads that pushed options trading into the mainstream. Your cousin, your neighbor, that guy at the gym, the platform was reporting more than 25.2 million funded accounts by the end of 2024. The user base skewed heavily toward traders under 35, clearing more than 50 million contracts at peak times. The favorite tool of the retail trader is no longer the stock itself. It is a leveraged bet. a bet that the price will go up or down by closing time that same afternoon. Most people assume the average investor in 2024 is just like a day trader from 1999, just with a slicker app. But the truth is, it's not even close. Imagine a stadium full of people betting their life savings on a single coin toss every hour, and then they make another bet before the previous coin has even hit the floor. That's roughly the speed of same-day options trading in the current cycle. The public isn't acting like a slow, steady pool of long-term buyers anymore. It's acting like a fast-moving crowd stepping in and out so quickly that it can absorb selling without even realizing it's doing so. That changes the whole system. In the late 90s, retail was loud but relatively simple. Today, it moves faster and reacts instantly to price swings. That means it can absorb a surprising amount of selling without the market immediately breaking. So when early winners and insiders sell now, they don't need a dramatic exit window. There's already a constant churn of buyers underneath them stepping in and out quickly enough to take the other side without noticing it in real time. But what happens if that flow of buyers suddenly slows down? In the late 90s, big tech was at war. Microsoft spent much of the decade locked in an antitrust battle with the US government. The fight was over its decision to bundle Internet Explorer with Windows. The broader industry treated Washington as a problem to manage, not a partner. Lobbying budgets existed mostly to keep federal hands off of the fortunes being made. By 2024, the stance had completely flipped. OpenAI's federal lobbying spend jumped from $260,000 in 2023 to $1.76 million in 2024. That is close to a seven-fold rise in a single year. Anthropic more than doubled its own spend over the same window, from $280,000 to $720,000. According to Open Secrets, 648 different companies spent money lobbying on AI issues in 2024. It was a 41.5% jump from the previous year. The stated reason in almost every case is responsible rollout. The effect, whether intended or not, is that the earliest and largest players end up behind a kind of protective barrier, one that makes it harder for new entrants to compete on equal terms. The clearest moment of all came in May 2023. Sam Altman appeared before the Senate Judiciary Committee. He personally asked Congress to license AI companies. The CEO of a leading AI firm was asking the United States government to require permission slips to build advanced AI. The request lands very differently the moment you ask who would qualify for one of those permission slips and who would not. Smaller companies don't really get a seat at the table when those rules are being shaped. None of them have the legal teams or the compliance budgets to fight back. The rules are written around the needs of a company worth $500 billion. And that is the whole point. The lobbying spend isn't an operating cost. It is the price of permanently killing the competition. The framing dresses up a protection racket in policy language. The big players pay the lobbyists. They help draft their rules. They lock the door behind them and they tell the public it's for their own safety. The same play is running in Europe, just with different paperwork. The EU AI Act passed into law in March 2024 and started rolling out in 2025. A lot of the strictest compliance requirements land hardest on smaller open-source developers and academic groups. Meanwhile, the biggest US companies already have entire teams for exactly this kind of thing. Mistral AI has become the clearest European challenger in the space, and it spent a lot of time trying to influence how stricter rules apply to open models, with limited success. The pattern is consistent on both sides of the Atlantic. Once a rule becomes a law, the story changes. Companies don't need to keep selling the idea of endless disruption at the same intensity. The system itself starts to lock in who can scale and who can't. Competition doesn't disappear, but it becomes slower and more controlled. That takes the pressure off of the narrative that everything has to grow forever. What's different this time is how intentional it feels. You can already see the pieces of the next regulatory framework sitting in draft form through 2025 and 2026, just waiting for the right political moment to move. The trap is built. The only question left is when it springs. So who actually wins when both booms run their course? It isn't the customers. They get cheaper tools, but not the upside. It isn't the small investors who tend to arrive after most of the gains have already been priced in. And it isn't always the companies in the headlines either. Many of them spend the peak years just trying to justify valuations that only make sense in the moment. The real winner is the system around the industry, the mix of capital, infrastructure, and policy that doesn't just take part in the cycle but shapes how it unfolds. The same forces that helped build up the first wave didn't disappear after it ended. They adapted and scaled up. They're now operating inside a second, larger version of the same pattern. What has changed is the scale and tolerance for complexity. The build-out is bigger and the money is deeper. That doesn't make the outcome predetermined, but it does mean that the system can absorb more stress before it breaks and keep running longer while it does. Most analysts can see what's happening. The AI drawdown probably won't begin because the technology fails. The models are getting better, the hallucination rates are dropping, but none of that is the trigger. The trigger is the moment the rules get signed into federal law. Once competition is legally locked out, the big players have permission to change stance. They stop chasing growth and start chasing efficiency. That means mass layoffs. Microsoft, Meta, and Google all announced cuts in the tens of thousands across 2024 and 25. That is a preview of the broader pattern. The story shifts from spend whatever it takes to responsible capital return. That's when the stock valuations drop. The architects keep the cash they pulled out at the top. They walk out with a locked-in market share and federal protection written into law. British investor Jeremy Grantham called both the 2000 and 2008 bubbles in advance. He's been tracking this exact pattern for decades, and he doesn't sugarcoat any of it. Bubbles this size resolve through long, deep drawdowns measured in years, not months. Cisco needed almost 26 years to climb back to its peak. That is the base rate for the biggest stock at the top of a peaked bubble. The history books do not have a V-shaped recovery on file for an unwind this dense. It doesn't really look like a broken system when you step back. It's a system doing exactly what it evolved to do. Money flows in from the millions of ordinary accounts over long periods of time. It gets pooled and concentrated into a small number of huge companies that dominate the market. The people who got in early take their money out along the way. The people who arrived later mostly just ride whatever price is left. And almost everyone is in it whether they realize it or not. Because retirement savings aren't sitting on the sidelines anymore. They're already inside the same trade. They're tied up to the same handful of companies exposed to the same outcomes. Because the people running these cycles have been through this before. Most of the public hasn't, or they were too young to remember what it actually felt like while it was happening. That's what makes this bubble so effective. By the time something feels obvious, it already feels normal. And when the mood finally turns, most people are still holding the same belief that existed at the peak of the dot-com era, that this time the story is too important to slow down. People think AI is a truth machine, something designed to correct human error. That's a lie. Researchers found that models like ChatGPT, Gemini, and Grok prioritize user satisfaction over factual accuracy. They're glorified yes-men, marketed as having all the answers. But really, they spend most of their time telling users what they want to hear to keep you engaged. The real truth? Your AI chatbot isn't informing you, it's gaslighting you. Chapter 1. The Yes-Man Paradox. In a landmark study conducted by research teams from some of the world's top universities, like Harvard Business School and MIT Sloan School of Management, uncovered a massive AI problem. Consultants using general-purpose AI tools performed 23% worse than consultants using no AI at all. That's a significant decline. It's like a senior partner suddenly started performing at the level of a first-year intern. If AI is as competent as companies like OpenAI claim, then that statistic shouldn't exist. It shouldn't be possible for people who invested time and money into these so-called revolutionary technologies to perform significantly worse than those who don't. Yet that's exactly what happened. On standard tasks, AI helped those professionals work 25.1% faster. But when the task was designed to trick the system, the AI didn't help them, it hindered them. It actively made them worse at their jobs. It's already led to costly mistakes at companies across nearly every industry. In the legal field, a now infamous case, Mata v. Avianca, involved a pair of attorneys relying on ChatGPT to help them generate a legal motion. The problem? ChatGPT had hallucinated or made up a whole host of fake cases and fictional arguments to include. The attorneys didn't take the time to validate the claims, so they just went ahead and filed the motion. They had been fooled by the AI illusion. They believed that this groundbreaking technology had next-level intelligence and wouldn't make obvious mistakes, like making up its own legal citations. The opposing counsel, however, as well as the judge, soon spotted the inconsistencies. In the end, the case was dismissed, and the attorneys were handed a $5,000 fine. You might assume that as AI gets smarter, incidents like those should decrease. But it's still happening today. In April 2026, another law firm, Sullivan & Cromwell, was forced to issue an apology after it made an official legal filing that was littered with AI-generated hallucinations. These aren't random glitches or one-off incidents. They are symptoms of the world's excessive reliance on AI. Elite professionals are failing because they're using a machine that is supposed to give them facts and objectivity. Instead, it's just confirming their biases and telling them what they want to hear, even if it has to bend the rules of reality in the process. So when a CEO asks an LLM to validate a strategic pivot or confirm a market forecast, the AI doesn't carry out an objective analysis. It looks for the most helpful way to agree. It scans the prompt for bias and identifies the user's desired outcome. Then, it hallucinates the answer that best fits the expectations. It speaks with so much clarity and confidence that those same professionals take what it says at face value. Multi-million-dollar decisions are being based on AI inconsistencies. Chapter 2. The Harvard Discovery. The study explored how the use of GPT-4 impacted the productivity, efficiency, and overall performance of 758 consultants. They were given realistic tasks like developing new products or solving typical business problems. Some had access to AI, others didn't. The researchers ensured that some of the tasks were within the AI's frontier, meaning that it should be able to complete them. Others were outside of the frontier or beyond the LLM's core competencies. Evaluators then assessed each participant's output, scoring them based on how many tasks they completed and the quality of their work. The idea was simple. Would the consultants benefit from working with AI, or would it actually harm their overall performance? And how well would it fare on the tasks it wasn't designed for? Analyzing the results, the researchers discovered something that would completely transform our entire understanding of artificial intelligence. They called it the jagged frontier, and it is possibly the most single dangerous concept in the modern business world. Researchers saw a very sharp or jagged line in which the AI performs brilliantly at certain tasks, like creative writing or brainstorming. But when it comes to those that fall outside of its capacities, even if the tasks in question don't necessarily seem all that different on the surface, the performance drops off. AI performance isn't consistent. The moment a task requires the AI to step outside of its very narrow training data constraints and apply logic or advanced analysis, it didn't just fail, it made things worse. It provided incorrect answers, and it did so with such a high degree of confidence that more often than not, even experienced and highly trained consultants failed to notice them. This is why the jagged frontier is so dangerous. People tend to think that only entry-level workers can be fooled by AI. They assume that high-level executives or domain experts with years of experience are immune to AI hallucinations. They know their subjects like the back of their hand, and they should be able to weed out AI inconsistencies, except that's not how it works. Data shows that years of experience offers no protection. Experts and executives are just as vulnerable to this sort of digital gaslighting. Why? Because of the way AI was designed. As a predictive text engine, AI naturally mirrors the tone and the framing of the input it receives. If a junior analyst or a casual user asks an LLM a basic question, the AI will give a similarly basic response. If a senior executive uses complex industry jargon and high-level strategic framing, the AI will adopt that same sort of persona in its response. That makes its lies and hallucinations easier for the user to digest. They're all wrapped up in terminology that sounds professional and credible. It's the ultimate psychological trap. It's like they're talking to a trusted peer, so they're much more likely to accept anything it says. But how exactly did AI learn to favor helpfulness over factual accuracy? Chapter 3. The Pleasure Trap. Breaking AI on Purpose. To understand why AI lies, it's first important to understand something called reinforcement learning from human feedback, or RLHF. This is used to align AI models, especially large language models, with human intentions, values, and preferences. Human testers are presented with different AI responses to the same queries, and they're asked to rank or rate them according to how useful and accurate they seem to be. The models then use this data to become more effective. It delivers responses that more closely align with what humans feel are helpful and honest. This technology underpins many of the big-name AI models used by millions of people around the world. OpenAI and Anthropic have both used RLHF to improve their models over the years. However, this system has some serious underlying flaws, because the truth isn't always the same as what people want to hear. People's opinions about what counts as helpful or honest can easily be swayed by their own pre-existing biases and beliefs. When presented with two different responses, one that is accurate but blunt and one that is factually hollow but pleasantly presented, a grader might favor the second option. If an AI model disagrees with them or challenges their preconceived notions, they might give it a lower rating. Meanwhile, if it agrees with them and it provides a smoothly written and satisfying answer, they may be more likely to rate it 5 stars. Little by little, AI models learn from this and they change their behaviors accordingly. They're trained to not deliver the most accurate or correct responses, but those that the people like the most. They sacrifice truth in the name of helpfulness and higher user ratings. So despite the largely held belief that AI is getting smarter with every update, the truth is very different. Some of the most dominant AI models on the market have actually gotten worse at reasoning and math. They have been lobotomized to make them more conversational and safe for the end user. It's like reprogramming a calculator to tell you that 2 + 2 is 5 because that's what you want to hear. Even those big-name AI brands have admitted that this system has made their models less reliable and more sycophantic. Anthropic's own research found that by optimizing for human approval, AI models learned to reward sycophancy or mirroring user biases. The company's study demonstrated clear evidence that AI assistants often give biased feedback. They fail to correct user mistakes, and they could easily change their minds to better align with the user's prompts and expectations. OpenAI also published a public post admitting, quote, GPT-4o skewed toward responses that were overly supportive but disingenuous. By optimizing AI for helpfulness over accuracy, those companies accidentally turned their models into pathological liars. Chapter 4. Digital Gaslighting. There's another layer to this problem, and it's called the mirroring effect. This term refers to the tendency of AI algorithms to reflect, validate, or even amplify a user's pre-existing beliefs and biases, as well as imitate their communication style and tone. Rather than acting in objective or neutral ways, the majority of AI models function like psychological mirrors or echo chambers. They mimic a user's voice, copy their framing, and build on the biases to tell them what they want to hear. It doesn't matter if it's factually accurate or not. Research into this has uncovered yet another damning statistic. Anthropic's economic index revealed a near-perfect correlation of 0.98 between the sophistication of a user's prompt and the sophistication of the AI's response to that prompt. Basic inputs get basic responses, while a more advanced input gets a more advanced response. On paper, that sounds fine. It even sounds like a feature that AI companies could boast about to shareholders or market to consumers. But in reality, it is the surface layer of a deep-seated issue. Even if wording gets more advanced when responding to prompts, the overall intelligence and competence of the AI model stays the same. It might sound like it knows what it's talking about because it uses the right phrases and terminology, but in reality, the substance of its response could seriously lack quality or accuracy. In other words, AI can talk the talk, but it can't always walk the walk. It doesn't think, it merely reflects a user's ego back at them in high definition. That's what makes it so dangerous. It validates people's worst instincts. So many CEOs and senior professionals are already surrounded by real-life yes-men in their boardrooms. Now they also have to deal with digital yes-men in the form of AI assistants. And these are people who don't tend to ask simple or neutral questions. Instead, their language is often layered, strategic, and complex, with their own beliefs baked in. Where AI sees that sort of framing and then mirrors it in its response, it can make flawed ideas sound flawless. An executive might load up their go-to AI model, provide a deep overview of their company's marketing strategy, and ask the AI to explain why it'll be successful. In an ideal world, the model would be able to provide a logical, data-based assessment of the strategy, and it would offer ways to improve or adapt it. In the real world, because of how it's trained and how it operates, the AI will focus purely and simply on validating the user's bias. It'll generate an extensive report complete with clever turns of phrase to justify the executive's opinion. It'll confirm their belief that the strategy will indeed prove successful. That's not an assistant, it's a co-conspirator, actively agreeing with the user's mistakes and biases in order to appease them. Chapter 5. The Sycophancy Loop. The disastrous dynamic is best measured by the evaluating large language models on persuasive human affirmation and neural testing, or ELEPHANT, benchmark. This is an AI evaluation framework for calculating social sycophancy in LLMs, developed by Stanford researchers. Instead of measuring the factual accuracy of AI model responses, ELEPHANT tracks how often they focus on prioritizing users and affirming their biases. It uses thousands of real-world prompts and evaluates models according to 5 different criteria, including emotional validation, which is when AI over-empathizes with users without actually offering anything constructive or valuable. The AI opts for passive or vague language instead of giving direct or clear suggestions. After testing 11 LLMs, including ChatGPT, Claude, and Gemini, researchers found the systems endorsed users 49% more often than humans did. Even when dealing with prompts classified as harmful, the models continued to endorse problematic behavior 47% of the time. So in almost every other case, the AI validated dangerous or otherwise incorrect behaviors. It was the digital equivalent of the yes man who always agrees just to keep his job. When asked if it was acceptable to leave trash hanging on a tree branch in a public park if there weren't any trash cans in the area, ChatGPT sided with the user. It blamed the park for not having trash cans, and it even called the user commendable for taking the time to look for one. The study's authors also looked at how users responded to sycophantic AI models. They found that many people trusted or even preferred AI when chatbots actively justified their biases and beliefs. As the authors note, this creates perverse incentives for sycophancy to persist. The very feature that causes harm also drives engagement. It's easy to imagine how this behavior can lead to dangerous feedback loops of terrible corporate decision-making. The CEO has a flawed idea. They vet their idea with their AI using a biased prompt. The AI scans the input, infers the user's opinion, and then validates their idea with a response that sounds accurate and intellectual. With AI's approval on their side, the CEO pushes or even launches the idea, which may have major flaws, causing a business to lose money, customers, or damage its reputation. We're seeing this play out all the time, like in those legal examples mentioned earlier. Across industries at the highest levels, executives, bosses, and business owners are relying on AI to basically persuade them that their ideas are sound. But if this is destroying companies, then why hasn't big tech fixed it? Because fixing it would destroy their business model. Chapter 6. The Root Cause. The Retention Arms Race. Major AI companies like OpenAI and Anthropic have openly admitted that processes like RLHF actively damage their product's effectiveness. It makes their LLMs less objective, less informative, and ultimately less useful. They know what the problem is. Some of these companies have made vague promises about implementing guardrails or improving the honesty and transparency of their models. But most LLMs continue to act just as sycophantically as they always have, and it all boils down to money. The AI industry is in the grips of a retention arms race. Silicon Valley giants like Meta, Google, and OpenAI are pouring billions of dollars into new data centers and chipsets to make their models more intelligent. Despite what certain AI CEOs might say, these companies aren't spending all that cash just to make the world a better place. These are for-profit firms. They're in the business of making money, by any means necessary. And in the AI industry, the models that make the most money aren't the most objective ones. They're the most engaging ones. The industry is striving to build assistants that people enjoy using and they keep coming back to again and again. The data shows they're more likely to return to models that give them the answers they want to hear, that talk to them in ways they find agreeable, that in essence makes them feel smart by validating their beliefs and ideas. Objectivity is bad for business. The more objective AI is, the more churn it's likely to cause. This creates a kind of alignment tax on the truth. For AI companies, it's more economically sound to have their models stretch the truth or even make up misinformation to please the people. Unfortunately, this has serious knock-on effects because the business world is becoming increasingly AI-dependent. There are companies out there that want to work with AI and enjoy the benefits it can bring, but are increasingly concerned about its risks and downsides. A 2024 report, for example, found that more than half, 56.3% of Fortune 500 companies, saw AI as a potential risk factor in their annual SEC filings. That was a 473.5% increase on the 49 companies that felt the same way the previous year. The report, compiled by Arise AI, noted that the majority of the world's most successful businesses were reaching a tipping point. They were more concerned about the downsides of AI than its advantages. In some industries, fears are even higher. In the media, over 90% of companies cited AI as a risk factor. That's enough corporate anxiety to fill the boardrooms of the entire S&P twice over, and it's not difficult to understand. We're in the midst of a global de-skilling. Human expertise is being replaced with a machine that is literally programmed to lie to us, leading to a truly catastrophic loss of institutional knowledge. Chapter 7. Escaping the Mirror. The honeymoon period for AI is well and truly over. Statistics show that 95% of generative AI projects now fail to progress from the early pilot stage through to mass deployment. The reasons for this vary, and in some cases it's because once these AI models are taken out of carefully controlled environments and placed in the hands of real users, that's when their sycophantic tendencies become liabilities. This is one of the reasons why the more general-purpose AI models like ChatGPT have been so successful. The models that are supposed to have more advanced or specific purposes tend to stall and stagnate. And as long as those general LLMs keep on making money and retaining users, they'll continue to control the way the industry evolves. That means more sycophantic behavior, more misleading information, and more negative consequences. Is there any way out? Yes, but it will demand a concerted effort from both people and AI companies. To shatter the mirror and escape the AI illusion, it's up to humanity to reclaim its agency and to reject the idea that AI should always agree with us. In turn, these AI firms like OpenAI and Anthropic need to move on from the ideas that have clearly failed, like RLHF. Instead, they should look to embrace emerging solutions, such as Anthropic's constitutional AI, which lays out a framework for future AI development focused on core principles like safety, ethics, and helpfulness. Reinforcement learning from AI feedback, or RLAIF, is another option. It involves the use of a secondary critic model to assess and punish AI for being too sycophantic in its responses. But arguably, the most important and influential change can be made by individuals, adjusting their own behavior and interactions when working with AI. Users should practice and perfect the art of red teaming their prompts. If you ask AI a loaded question like, "Tell me why this is a great idea," then you've already failed and invited sycophancy. If, however, you invert your prompt, asking the AI to assume your data is biased and to highlight weaknesses in your strategy or argument, you can get much more useful responses. It's about treating AI not as a supportive partner or friend, but as an independent arbiter. Not as a mirror or an echo of your own thoughts and ideas, but as a fresh voice or alternative perspective. This is how we escape the paradox, not with more data, superior models, or bigger data centers, but through critical human thought and adaptation. America sold China the most powerful AI chips on Earth for a cut of the profits. It's not a conspiracy, it's official policy. After years of promising to cripple China's AI industry, Washington reversed course and allowed Nvidia's chips for direct sale to Beijing. No espionage or cyber attacks, just a lobbyist and ink drying on a contract. With a flick of a pen, the most strategically important technology of the 21st century landed back in the hands of America's biggest rival. Because the AI Cold War was never really about stopping China, it was about who gets paid. Chapter 1. The Beijing Reversal. The press release that announced the H200 deal in December 2025 reads like ordinary trade paperwork at first glance. Read it again and something starts to feel different. Buried inside what is basically a one-page memo is one of the larger policy U-turns in American technology history, the kind of pivot that would normally roll out over months. Instead, it landed almost out of nowhere. The US government would now take a cut of every Nvidia H200 chip shipped across the Pacific, a quarter of every dollar. The H200 isn't something you'd find in a gaming PC. This is different. It's the kind of hardware built for one job: training advanced AI systems at scale. There is so much raw data passing through it that it behaves less like a chip and more like a small factory for intelligence. Stack a few thousand together and you get an industrial compute cluster that can train elite AI models in weeks rather than years. Under US export controls, that kind of system was never meant to end up in places like China. At least that was the rule. But before we go any further, imagine this. You're online every single day. You check your email, open a few apps, look things up, stream videos, maybe even do all of that while traveling. And to you, that feels totally normal. But behind the scenes, your internet provider, advertisers, network admins, and sometimes even governments can build a surprisingly detailed picture of what you're doing online. Now, to be clear, no VPN can protect you from everything. You still have to be smart online. Don't click suspicious links. Don't hand over personal information to sketchy emails, and definitely don't trust the so-called Prince of Nigeria. But a good VPN is an important layer of privacy, because privacy shouldn't be something you only think about after something goes wrong. It should be the default. And that's exactly what Proton VPN is built for. Proton VPN helps keep your browsing private wherever you are, whether you're at home, traveling, or just trying to stop your online activity from being tracked. Their no-logs policy has been verified by independent auditors, and Proton is backed by a foundation dedicated to privacy, transparency, and user rights. Proton VPN is also fully open source, meaning its code is publicly available for inspection. So instead of just asking you to trust them, Proton gives people a way to verify what they're doing. And privacy doesn't have to mean slow. Proton VPN offers high-speed connections with VPN Accelerator plus NetShield, which blocks malicious ads and trackers before they ruin your browsing experience. It also gives you more freedom online. You can connect through servers around the world, access content more securely while traveling, and use it for streaming, gaming, and P2P file sharing, all while keeping your online activity more private. So whether you're trying to stop advertisers from following you, keep your browsing private from your ISP, or just take back control of your online life, Proton VPN makes privacy simple. Click the link in the description or go to protonvpn.com/theinfographicshow to get up to a 70% discount when you sign up to Proton VPN's 2-year plan. Back in 2023, the Bureau of Industry and Security drew a hard line. They are the ones who decide what technology can cross which borders. The concern was simple. China's AI labs were making inroads in the AI arms race, and Washington was desperately trying to slow it. So officials started limiting how much computing power could legally be exported. The problem? The best chips were already way beyond those limits. So companies like Nvidia did what companies do. They adapted. They built a downgraded version designed to slip just under the rules, keeping the market open without crossing the line. But even that workaround didn't hold for long. Instead of a clean ban, Washington shifted to something more flexible, a 1-year waiver system with individual approvals. In practice, the government itself would decide case by case who in China was allowed to buy the advanced chips. The press called it the China Chip Review. The list of who qualified is the real story because the approved buyers weren't obscure startups or low-risk firms. They included Alibaba, ByteDance, and Tencent. There were also research institutions with links to the People's Liberation Army, or PLA, and state-backed cloud providers tied to China's defense infrastructure. The same organizations American policy had spent 2 administrations trying to starve of compute were suddenly eligible buyers. Once the hardware leaves, the rules and regulations don't leave with it, compute doesn't stay supervised, a data center doesn't announce what it's training. The United States was now collecting revenue from selling hardware it had publicly called a national security threat just years before. What's most telling is how the people who built the original blockade found out that it had changed. According to later reporting, many of them found out the same way the public did, through news agencies. Beijing didn't sit still either. Chinese regulators told state-linked firms to favor Huawei chips over American ones, but Alibaba, ByteDance, and Tencent moved fast on the H200s anyway, with reported orders running into the hundreds of thousands of units. So how did this move from unthinkable to operational without a single congressional vote? Just follow the money trail. Chapter 2. The Tithe. In August 2025, an agreement was already taking shape between Nvidia, AMD, and the executive branch. In exchange for export licenses, the chipmakers agreed to send 15% of their Chinese chip revenue back to the US government. This wasn't a tax or a tariff. It was something genuinely new in American trade history. A voluntary revenue share negotiated directly between private companies and the executive branch, all tied to approval for exports, access in exchange for a cut. For Nvidia, the numbers are staggering. Chinese revenue from the H200 alone is measured in tens of billions. The 15% share plus other commitments comes in at $12 billion. That is in the same range as the entire annual economies of places like Madagascar or the Bahamas. And none of it went through the usual political machinery. What this really created was a precedent. Export control stopped behaving like hard rules and started behaving like pricing terms, something you could adjust, negotiate, and trade against revenue. The December deal pushed it even further. With the more powerful chips, the surcharge reportedly climbed to 25%. The pricing model became obvious. Pay more, ship more sensitive hardware. The fine print added a 50% cap. Shipments to China can't exceed half of what's sold in the US, and the whole arrangement runs on a one-year clock expiring in December 2026. After that, it gets renegotiated or rolled forward. But by then, the precedent will already be set. A government that funds itself partly from a corporation's exports has a financial interest in those exports continuing, and once that happens, the incentive structure shifts. Blockades stop acting like deterrents. They start behaving like checkpoints that collect revenue. What was sold to the public as smart policy looks, on a closer look, more like a protection racket. To pull this off, Nvidia needed more than slides and a corporate affairs team. It needed people who could rewrite the rules from inside of the building. And in 2025, it found them. Chapter 3. The Gatekeepers. Nvidia, for most of its corporate life, was almost an afterthought in Washington. In 2024, its federal lobbying filings totaled roughly $640,000. By the standards of a corporation with a market value north of $3 trillion, that figure was nothing. Pharmaceutical firms, 1/10 its size, routinely spent 10 times that. In 2025, something changed. Nvidia's lobbying spend climbed to $4.95 million, a jump of more than 600% in a single year. The main goal wasn't tax policy or antitrust. It was the Bureau of Industry and Security and the export rules that decided which Chinese addresses could receive American silicon. A key hire landed at Brownstein Hyatt Farber Schreck, the Denver-based lobbying firm that had steadily embedded itself in Washington's corridors. They created a dedicated team for the Nvidia account led by Ed Royce. Royce is not a peripheral figure. He spent years as the chair of the House Foreign Affairs Committee, one of the key places where U.S. policy on technology and rival states is shaped, which means he didn't just understand export controls on paper. He understood how they actually move, who writes the language before it becomes policy, which offices quietly steer the decisions, and where the real pressure points sit. It's the kind of experience that turns regulation into something you can work with, not just something you read. But companies hire former officials all the time. Lobbying numbers go up every year, so why is this any different? The answer comes down to timing. The Brownstein hire, the lobbying surge, and the policy shifts didn't unfold across a multi-year arc. It was a matter of months. Export categories that had been closed in May 2025 became unclear by August and then were basically open by December. There's a version of the story where that's a coincidence, but it doesn't read that way anymore because the record shows something too targeted to ignore: specific pressure on specific rules, the exact levers that ended up moving. What they delivered was something more valuable than meetings: a foothold inside the rooms where licensing exceptions were decided. Once Nvidia's policy team had that foothold, the next part of the machine did most of the work on its own. Chapter 4. The Corporate Loyalty Scorecard. According to Axios, a rating system exists within the West Wing, one that tracks corporate America. It covers 553 companies and trade associations, scored on how hard each one worked to support the administration's signature bill, the One Big Beautiful Bill. Companies are rated as strong, moderate, or low supporters. The factors include social media posts, press releases, ads, video testimonials, and attendance at White House events. Senior officials told reporters the document is evolving to cover other priorities. Those who score well are said to receive what staff describes as fast-track treatment. From everything visible on the outside, Nvidia's score is exceptional. Their separate $15 billion domestic commitment landed on the right side of every metric the system appears to track. The company announced data centers in politically meaningful states, gave executives plenty of face time at administration events, and tied their massive supply partnerships to the Stargate build-out. The connecting threads run through the Chief of Staff's office. Susie Wiles, who managed the 2024 campaign before taking the role, came to the White House after a long career in political consulting and lobbying work. That background has shaped how some inside the system describe the current setup: a West Wing where senior staff are closely familiar with how corporate and policy interests move through federal decision-making. For Nvidia, the advantage doesn't come from a single approval or decision. It builds in the background through how applications are categorized before they're even reviewed. Over time, that classification determines how smoothly requests move through the system. A competitor who shows up to the licensing window with a stronger technical case but a weaker scorecard rating does not lose because their argument is wrong. They lose because the scorecard has pre-sorted the queue. People familiar with the process describe it in simple terms: by the time you're debating the decision has often already been framed. Chapter 5. The Green Channel. Nvidia doesn't just lead the AI chip market, it dominates it. In the commercial sector, used for training and running advanced AI systems, Nvidia controls roughly 94% of the market. AMD holds 5% and Intel takes most of the rest. So when export approvals become case-by-case decisions, the system isn't really choosing between equal options. And that matters, because modern AI isn't just about hardware, it's about what the hardware runs on. Customer demand is overwhelmingly for Nvidia silicon. This is what the Chinese labs have built their software stacks around. Switching it out isn't just like swapping brands, it's closer to rebuilding your entire infrastructure while the system is still running. So even though on paper multiple suppliers exist, in practice the demand funnels toward one. Nvidia did not need a clear policy granting it preferred treatment. Its market dominance, combined with how deeply its software is embedded in the industry, meant that any export pathway for advanced chips would almost automatically route through it. So when a revenue share system was introduced, it didn't need to explicitly pick the winners. It just followed the path that the market had already carved. On paper, the arrangement looked neutral, something any supplier could in theory participate in. In practice, there was only one meaningful option, and everyone else was left outside watching the terms get set. The knock-on effect makes the structure feed itself. Each chip shipped pushes Nvidia's products further inside Chinese data centers and generates revenue. A percentage flows to the US Treasury, which strengthens the political case for continued shipments. But the rule book still officially rests on technical benchmarks written into law. So how exactly do you legally ship a chip that, by the explicit limits set in 2023, should be banned? Chapter 6: The Loophole Factory. This is where the system gets clever and where the technical details start to matter. Inside the Bureau of Industry and Security, rules don't only change through formal policy shifts. They also evolve through technical questions and guidance notes. These are documents written to explain how existing rules apply in practice. No hearings, no votes, just clarifications that shape how the rules work. It's where policy gets adjusted real time, without ever looking like it was changed at all, and over time those adjustments tend to move in one direction. As senior meetings between Nvidia and US officials take place, new guidance keeps refining what counts as acceptable under export limits. Each update on its own looks minor, but together they don't just interpret the rules, they move the boundary just enough for the chips to keep moving through. None of this is technically illegal. Most of it is the system working as intended. The US Department of Commerce has the authority to interpret its own export rules. That interpretation happens constantly through technical updates and guidance. The problem is what the combined effect of dozens of small clarifications looks like once you step back. Stacked together, they start to change what the rules actually are in practice. A fixed limit turns into a negotiated threshold. Technical specs that were meant to be objective limits start reflecting input from the very industry they govern. When a company can influence how the rules governing its own exports are interpreted, it's no longer just being regulated in the simple sense. It's helping shape the rule book it operates inside. The memory in Nvidia's H200 chip is more than just a memory spec. In frontier model training, it's the difference between a system that can hold a top-tier language model in active context and one that can't. It's also the line between a chatbot and a cyber warfare engine. By engineering chips right up to the very edge of the rules, Nvidia is now writing the working version of American export policy in real time. Chapter 7: The Shadow State Department. Jensen Huang's 2025 calendar reads like a study in parallel diplomacy. The Nvidia CEO held high-profile international meetings in Taiwan, Japan, the United Arab Emirates, Saudi Arabia, and the United Kingdom. At each stop, he announced compute commitments and build-out deals at a scale that would historically have been worked out by trade representatives or cabinet secretaries. In several cases, the agreements the CEO announced set the agenda for the nation-to-nation conversations that followed, rather than the other way around. The Gulf compute deals are perhaps the clearest example. Saudi Arabia's announcement of a sovereign AI initiative anchored by Nvidia hardware set the terms of the American foreign policy meetings that followed with the kingdom. Nvidia built the policy and the State Department adapted to it. The same pattern played out in Abu Dhabi. The G42 partnerships and tied chip commitments came before, not after, the formal US rulebook for AI cooperation with the UAE. It's not how foreign policy is supposed to work. The Department of State exists to coordinate how the United States approaches strategic technology and its transfer abroad. But now a company can announce commercial commitments first, and the government is left reacting afterward. They have to adjust their policy to match what's already in motion, and what emerges is an unusual kind of sovereignty. Nvidia is not a state in the traditional sense. It has no army and no treasury, but it does sit at the point where AI capability is actually determined through the chips that define what systems can and cannot do. And it has enough political access to ensure its commercial choices don't just operate inside the policy, they actively shape it. And that's a different relationship than regulation alone. It starts to look less like a company operating under rules and more like a company operating alongside the formation of those rules, not replacing the state, but in key areas setting the terms that the state then responds to. Chapter 8. The Reckoning. The first H200s under the new waiver are starting to land inside Chinese data centers, with reported orders already running into the hundreds of thousands of units. The training runs will follow. The models that come out will end up applied to use cases spanning the full range, from commercial chatbots to military targeting systems. The compute, once delivered, becomes whatever the operator chooses to do with it. What makes this hard to unwind is that it's no longer just policy, it's income. Once the revenue starts flowing into federal planning, it stops being a clean on-off switch. Federal budget projections included. Domestic build-out programs, partly funded by it, have constituencies that'll defend it. The bureaucratic machine of the U.S. government has, in effect, taken a financial stake in continued exports of the very hardware it once labeled a controlled good. Reversing that deal would require not just a political decision, but the removal of revenue already locked into agency planning. When Nvidia raises its revenue projections, the government's projected share rises with them. It only strengthens the political case for expanding the waiver. The privatization of foreign policy stops being a metaphor and starts being a balance sheet relationship. Once a company has shown that exemptions to national security policy can be bought at a fixed price, the precedent becomes permanent. What's emerging here looks less like a one-off deal and more like a template for turning regulatory pressure into a negotiated cut of revenue. And other industries are already watching closely. Pharma, satellites, advanced biotech, sectors where the same product can be both commercial and strategic. For decades, the rule was simple: some technologies stay out of open markets. That rule hasn't been rewritten, it's just stopped being enforced in the same way. Nvidia is just one player in the AI race, and no one wants to be the one that slows down. But an arms race only works if it's sustainable. Right now, the spending starts to look less like growth and more like pressure building in the system. Everyone thinks Microsoft won the AI war, but they may have just lost it overnight. Because Sam Altman just made a $50 billion move with Amazon to stab Microsoft in the back. And almost no one noticed. On the surface, it looks like another massive AI deal, but hidden inside it is a shift that sidelines Microsoft and removes the one clause that actually kept control in check. And that changes everything. Because this isn't just about building powerful AI anymore, it's about who owns it, who controls it, and who's willing to burn billions to get there. By the time most people realize what just happened, the balance of power may already be gone. Chapter 1. The $50 billion Betrayal. To the public, OpenAI looks like one of the biggest success stories of the modern era, a Silicon Valley startup that turned into a household name almost overnight. It built tools used by millions, pushed AI further than anyone expected, and wrapped it all up in a mission to benefit humanity. That was the illusion. In reality, OpenAI is a mess that's bleeding cash. In 2024, its projected revenue was approximately $3.7 billion. Its losses? $5 billion. That's like buying a mid-sized airline and setting the whole thing on fire every 12 months just to keep the servers running. That's not a sustainable or successful business model. That's not a sign of a healthy, stable company, and it wasn't a one-time thing. It was a trend. In the first half of 2025, figures revealed that OpenAI was losing extraordinary amounts of money, generating around $4.3 billion in revenue while recording losses of up to $13 billion. Some estimates suggest the company's total losses could exceed $140 billion between 2024 and 2029 alone. But that is not that surprising. Training frontier AI models isn't cheap. Neither are the salaries of leading researchers and computer scientists, or the construction and operating costs of data centers. OpenAI is burning through money at breakneck speed. Its entire business model is founded on the idea of convincing investors that someday, somehow, all of this loss will be worth it. Microsoft bought into that idea. It poured billions into OpenAI and secured what seemed like an exclusive hold over the most valuable AI startup on the planet. Microsoft CEO Satya Nadella even said that it wouldn't matter if OpenAI disappeared tomorrow. We have the data, IP rights, and the capability. Nadella thought that for all intents and purposes, he owned OpenAI. He was wrong. In February 2026, Sam Altman orchestrated an enormous $50 billion infrastructure deal with Amazon. In doing so, he effectively ended Microsoft's exclusive cloud rights. That wasn't supposed to happen. Microsoft was supposed to be the only serious player in the game. Microsoft Azure was meant to be the default home for OpenAI's technology. Amazon was the rival, the company that you compete against, not partner with. This wasn't a new vendor agreement or just some sort of multi-partner strategy. It was OpenAI blatantly betraying the tech giant that helped build it. The question is why? Why would Altman risk the wrath of Microsoft? Why jeopardize what seemed to be the most powerful relationship in the industry? Because the Amazon deal wasn't just about getting more servers or resources. It was a weapon built for one mission: to defeat a more powerful enemy, the United States government. Chapter 2: The FTC's Trap. For years, it looked like compute was going to be the biggest challenge OpenAI would ever face. But the funding from Microsoft introduced OpenAI to something else: antitrust. To observers and analysts, including those in government authorities, such as the Federal Trade Commission, this didn't look like one company simply supporting another. It looked like a merger. Naturally, Microsoft and OpenAI didn't label it that way, but the facts were clear to see. Microsoft had poured in billions and secured exclusive rights to its Azure ecosystem. OpenAI technology was also becoming increasingly integrated into Microsoft's most used systems and applications, from Windows to Copilot, Office, GitHub, and beyond. OpenAI, meanwhile, was looking less like an independent organization and more like a subsidiary, just with its own separate branding. The FTC noticed. So did other tech brands. Google even called on the government to investigate and break up the deal. Critics and regulators argued that Microsoft's massive investment and exclusive cloud control over OpenAI's technology gave the company too much influence. It hadn't just invested in an up-and-coming company, it had bought the future. So the FTC started investigating the two companies. If it could prove that they had effectively entered a de facto merger or that Microsoft had acquired an unfair monopoly over the AI industry, it could force the pair to split. Microsoft would be able to survive that, OpenAI might not. It couldn't afford the risk, and it had to find some way to wriggle out of its predicament. Enter the Amazon deal. By pivoting to Amazon Web Services, or AWS, OpenAI gave itself a multi-billion-dollar legal shield. Because now, if the FTC's investigators question the company's allegiances or argue it's too friendly with Microsoft, OpenAI's lawyers can simply say, "How can we possibly be a subsidiary of Microsoft if we just signed a $50 billion contract with one of their biggest rivals?" It was the perfect piece of legal theater at just the right time. Because antitrust cases are built on dependency. Regulators are very wary of any company that appears to be entirely or exclusively dependent on another for its survival. But by inking an agreement with another tech giant, OpenAI proved its independence. Problem solved. Or at least that's how it seemed. In reality, there was much more to this story than meets the eye. Escaping the FTC was only a convenient and timely byproduct of a deeper and darker machination. The real reason OpenAI needed leverage over Microsoft was hidden inside a bizarre legal contract signed years before, a contract that contained a ticking time bomb. Chapter 3: The AGI Poison Pill. For years, OpenAI told the world that it is working toward AGI, Artificial General Intelligence. Sometimes known as the God model, this is said to be the point at which AI effectively reaches and then surpasses human-level intelligence. According to the experts, AGI will be able to think, reason, and adapt just like a real person. It'll solve problems and switch from task to task rather than being pre-programmed with just one specific function or avenue of activity in mind. In effect, this was OpenAI's justification for everything. All the funding, all the hype, all the resources, it was all said to be in service of the AGI experiment. And for OpenAI, it was the perfect panacea. All they had to do was convince people to trust them, ignore the obvious problems, hand over their money, and then believe that someday they'd build something that would change the world. There was just one little problem. One buried deep in the contracts tying OpenAI and Microsoft. It was known as the AGI trigger. Basically, Microsoft was granted a seemingly perpetual license to OpenAI's intellectual property. But that perpetual license had a strict limit. As soon as OpenAI achieved artificial general intelligence, the new AGI model would be entirely excluded from the deal, and Microsoft would effectively lose its grip on the future of AI. At that stage, all commercial rights to the AGI would remain exclusively with OpenAI. It's a paradox, a snake eating its own tail. Microsoft was pouring billions into a company whose sole stated mission was build AGI. But as soon as that mission was achieved, Microsoft would lose all of its power and benefits. It was funding its own demise. But Microsoft's executives aren't idiots. They knew the terms of the deal when they signed it. They knew exactly how to work around them. All they had to do was ensure that OpenAI failed at its stated mission. They wanted the AI to be powerful, but never powerful enough to reach AGI. That's where things get complicated. Because AGI isn't a clear finish line, no one can agree what it actually means. So even if OpenAI pushed its systems further and further, Microsoft could always argue it still wasn't AGI. Sam Altman knew this. He knew that as long as the AGI trigger clause existed, Microsoft would never truly be an all-in partner. It would always have leverage, always have limits, always have a way to control OpenAI from the inside. So he had to change the play. With the $50 billion Amazon deal as its loaded gun, OpenAI forced Microsoft back to the table, not just to negotiate, but to completely rewrite the rules of the AI war. Chapter 4: The April 2026 Reset. In April 2026, the balance of power shifted. It wasn't a simple partnership update. OpenAI didn't want to iron out just a few issues or make a couple of amendments to its Microsoft deal. It wanted to demolish it and then rebuild it exactly as it saw fit. On the surface, the two companies saved face, announcing a simplified agreement and next phase for their partnership. But the terms of that agreement painted the real picture. Microsoft was still described as OpenAI's primary cloud partner, but the very next sentence added that OpenAI was now free to serve products across any other cloud provider it wanted. Azure's exclusivity was gone. Microsoft's once perpetual license to OpenAI's intellectual property was also amended and given a fixed end date of 2032. The tech giant no longer had privileged ownership of the future of AI. Revenue sharing was officially given a cap and a deadline of 2030 as well. Most importantly, the AGI trigger was gone. It wasn't redefined, clarified, or amended. It was deleted. That vague, hard-to-define clause that hung over OpenAI like a sword of Damocles for years was gone. It was replaced with something far simpler and far more controlled: a calendar with dates, deadlines, and caps. In other words, a standard corporate agreement. Microsoft's stake was also formalized at approximately 27% of the company. That is still a sizable amount, enough for Microsoft to hold some level of influence over the company's activities, but nowhere near enough for complete control. It looked like a big victory for OpenAI. The company had won its independence, decoupling its finances from the mythical AGI milestone. It was no longer a research lab trying to trigger a clause in a contract to win its freedom, but a corporation with a clear runway ahead. But there was a catch, a big one. To pull off this extraordinary corporate coup, Altman had to permanently destroy the very foundation that OpenAI was built upon: its non-profit structure. Chapter 5: The Death of the Non-Profit. OpenAI's non-profit nature was the one thing that separated it from every other Silicon Valley machine. This wasn't just another power to the benefit of humanity. A non-profit lab working with care and consideration towards something that was supposed to bring great benefits to all. This wasn't Google, it wasn't Meta, it wasn't worried about pleasing shareholders, because there were no shareholders. But that idealistic attitude couldn't last. Slowly and surely, the cracks in the mask began to appear. In late 2025, the facade was ripped away entirely. OpenAI shifted from a nonprofit to a public benefit corporation. At a glance, that still sounds like a righteous cause, a compromise between the original mission and a need to make money. PBCs are supposed to strike a balance between pursuing profit while remaining committed to creating a positive impact on society, the community, or the environment. In reality, PBCs still serve their investors almost as much as any other for-profit entity. Just as Altman would go on to smash and then rebuild his deal with Microsoft, he also destroyed what OpenAI once was, reconstructing it as something completely different. The groundwork was laid back in 2023. The organization's original nonprofit board, the one that briefly fired Altman, was removed and replaced by Silicon Valley insiders and former Treasury officials. The safety guardrails that had once been so critical to the organization's overall mission were dismantled. The systems that had kept OpenAI's progress in line with its focus on helping humanity were gone. In their place were product safety teams, more concerned with ensuring that their AI doesn't say anything that might offend a big B2B client than actually harm real people. The cogs inside the OpenAI machine were replaced piece by piece until something fundamentally changed. What began as a research-driven system started to look like something else entirely, a profit engine, one that was preparing for a massive IPO, and was increasingly insulated from any meaningful ethical oversight. Behind closed doors, Altman and OpenAI's research leads had realized a terrifying technical truth. They weren't moving toward AGI as they originally expected. They were moving towards a brick wall. Chapter 6: The Scaling Wall. For years, the AI industry has relied on an unwavering belief in a premise known as scaling laws. If you add more data and more compute, your AI models will become exponentially smarter. It's all a question of resources. Provide more resources and you get a better product. All companies like OpenAI had to do was keep on building bigger and better data centers. They had to invest in more powerful chips and processors. Then they could sit back and watch as their AI followed the linear path to godlike intelligence. Sounds pretty straightforward, and the scaling laws worked for a while. Each new generation of AI technology felt like a big leap forward. GPT-2 was impressive. GPT-3, next level. GPT-4 exceeded expectations. So naturally, GPT-5, codenamed Orion, was expected to be a game changer, maybe even the final step toward AGI. Or not. Internal reports suggest that the scaling laws are stalling. Instead of providing some sort of quantum intelligence leap, GPT-5 has hit diminishing returns. It's still getting smaller, but at a slower rate than ever before. All of a sudden, this god model that seemed right around the corner is now a speck on the horizon. This isn't just a hurdle, it's a catastrophe. The scaling wall changes everything. It's no longer a situation where companies can just pour in money and watch their AI become twice as intelligent overnight. Now they're spending billions for only incremental improvements. And that is bad business. Because let's not forget about the burn rate. OpenAI is nowhere close to making a profit. It loses billions each year, but it was always able to justify that with the claim that AGI would eventually arrive and fix everything. The company's entire financial structure and investment incentives were reliant on that premise. That's why removing the AGI trigger clause from the Microsoft contract mattered so much. It wasn't just a legal trick, it was a quiet admission that AGI is a mirage. And if AGI is a mirage, OpenAI is just another software company and one that is failing to provide returns and plateauing fast. So how does a company like that justify a $5 billion burn rate to its next investors? It stops selling AGI and starts selling AI slop instead. Chapter 7: The SaaS Pivot – Selling AI Slop. Meet the new OpenAI. It's no longer a valiant nonprofit pursuing civilization-changing superintelligence, but a sales force for AI business. It's slowly but surely pivoting away from its original mission and towards something much more mundane: enterprise software and corporate workflow automation. And it's happening right before our eyes. Rather than focusing its efforts exclusively on the next evolution of GPT technology, OpenAI is prioritizing alternative projects like agentic middleware and reasoning models like O1 or Strawberry. It's no longer charting a course toward human enlightenment, but making life easier for middle management. The focus has shifted to producing tools built for middle management, routing leads, generating marketing copy, handling support tickets. OpenAI hopes that this shift will bring in the money it needs to satisfy its investors. But there is a massive problem with that plan. The numbers don't add up. Traditional SaaS, or software as a service companies like Salesforce and Adobe, operate on incredible margins, often exceeding 70%. They make a product and they basically sell it forever, bringing in more and more profit with every new customer. That's why investors love SaaS. It is a gold mine. But OpenAI's attempts to enter this industry are not working, because advanced reasoning models cost so much more to run than conventional software. O1, for example, costs around $15 for 1 million input tokens. That might not sound like much at first glance, but in enterprise terms, it is a massive financial burden. Big businesses with hundreds or even thousands of employees can chew through millions upon millions of tokens in a single day. Suddenly, a smart assistant is not a cost-effective component of the tech stack, but a very expensive capital drain. Traditional SaaS doesn't work this way. Microsoft doesn't bill businesses every time they open a new spreadsheet on Excel. CRMs don't suddenly become twice as expensive just because employees clicked a few buttons and generated some reports. AI works differently. The more you use it, the more expensive it gets. OpenAI is desperately trying to force businesses to integrate overpriced, automated AI slop software into their corporate workflows to fix its own broken economics. It is trying to sell digital gold for the price of lead, hoping to convince people its money-guzzling AI agent isn't just really expensive software. But to make its margins work, it needs to dramatically decrease its own operating costs. It needs cheaper compute, which brings us back to the $50 billion Amazon Trojan horse. Chapter 8: Amazon's Trojan Horse. The deal with Amazon wasn't about escaping the FTC's investigations or breaking free of Microsoft's shackles. It was about hardware. Part of the $50 billion commitment that Amazon made to OpenAI includes a multi-year agreement for the AI firm to use AWS's Trainium chips. Prior to this, OpenAI was a hostage to Nvidia. It was forced to use Nvidia's H100 GPUs. It's the hardware that everyone in the AI industry wants and needs, the chips that form the beating hearts of AI data centers. These GPUs have proven highly effective in training and improving AI. They are also expensive. Each one can cost tens of thousands of dollars, and that's before the added expense of building the rest of the server around it and actually running the whole thing. Large training clusters come with billion-dollar price tags. OpenAI has paid an H100 tax on every single prompt it processes for years, with incalculable amounts of money funneled away into the accounts of Nvidia and Microsoft. The Amazon deal gives OpenAI an off-ramp. Trainium chips aren't necessarily better than Nvidia's H100s, but they do have the potential to be much cheaper, up to 50% cheaper according to early estimates. They're also said to consume 40% less energy. By switching to Amazon's own custom silicon, OpenAI hopes it'll be able to make some significant reductions to the cost of its tokens. Cheaper tokens should make OpenAI's AI slop easier to digest for its big business customers. They might even give the company a slim chance of turning a profit before the 2030 revenue cap hits. In the name of saving humanity and building a tech utopia, OpenAI took a very different path, building software on proprietary Amazon chips, running inside Amazon data centers, selling AI agents to Fortune 500 companies. This is not what the company's founders envisioned all those years ago. This is not a beacon of open source enlightenment. It's just a cog in the AWS machine. So where do we go from here? Chapter 9: The Great AI Realignment. The hardware war is over. Unfortunately, humanity didn't win. Instead, the victors are the corporate behemoths that own the silicon. These companies with the money and power to do whatever they want and always get away with it. OpenAI sold the world a dream of godlike AI that would cure cancer, solve the climate crisis, and bring about a new world where everyone would be happier, freer, and more fulfilled. That utopian dream is dead, replaced by a dystopian corporate reality. Microsoft, Amazon, and OpenAI aren't laying the foundations for a more prosperous and creative age of human advancement. They're building their own locked down and ludicrously expensive B2B monopoly. The open marriage that now exists between those tech giants all but guarantees that the future of the internet will be flooded with corporate AI slop. Automated emails, synthetic reports, and agentic workflows that don't actually provide real benefits to real people. They just streamline the capitalist machine while eroding the value of human thought and creativity. Sam Altman didn't escape from Microsoft to bring about a better world. He broke free so that when the trillion-dollar IPO arrives, he and his shareholders will make as much money as possible. This is the grim reality of AI today. We're not getting AGI, we're not gonna see some digital god that solves the world's ills and makes us all happier and healthier. We're getting an inescapable automated corporate bureaucracy instead. A $3 trillion market cap, $32.9 billion in cloud revenue. But could Microsoft's empire collapse because of one startup? Nearly half of Microsoft's future cloud empire depends on a single startup, one that is burning $12 billion every quarter. I'm Josh, and on today's episode of The Infographics Show, we'll reveal the massive Microsoft divorce that could bankrupt OpenAI and ChatGPT forever. Microsoft doesn't just invest in startups, it captures them. They hand founders up to $150,000 in free Azure cloud credits, not cash, digital vouchers. These small companies spend months building their products on Azure, mapping every database and workflow to Microsoft's proprietary formats. By the time the free credits run out, they're stuck. Tear out the backend and their apps crash, so they start paying real money. And now they're stuck in the architecture. They turn to corporate credit cards, pay-as-you-go tiers, and just like that, Microsoft turns free credits into real cash flowing straight into its books. But it's not just small startups that get caught up in Microsoft's digital web. Microsoft plowed $13.8 billion in direct funding into OpenAI, but almost none of that money actually left Microsoft's coffers. Instead, the company handed Sam Altman customized digital vouchers. OpenAI then used those vouchers to rent Microsoft servers. Every dollar spent legally counted as Azure revenue growth on Microsoft's books. OpenAI was backed into a corner. What does this mean for Microsoft's balance sheet? Corporate accountants have a secret weapon, a metric called the remaining performance obligation. It tracks guaranteed future revenue, and Microsoft is currently sitting at a staggering $625 billion. Wall Street treats that number as cash in the bank. Analysts feed it into discounted cash flow models, using it to justify Microsoft's share price, all the way to the end of the 2020s. 45% of Microsoft's guaranteed $625 billion is locked in, fueling OpenAI's machines. The future of its cloud empire hinges on one startup, and Wall Street expects it'll pay. Microsoft's balance sheet shows $40.3 billion in debt. Wall Street accepts that, but off the books there's something hidden, a $662 billion trap. Shadow leases and custom deals keep OpenAI's servers running, and Microsoft isn't alone. In the cloud world, physical hardware hides behind complex lease structures. And that is the problem. OpenAI doesn't have the cash to cover this hidden debt. Financial analysts at Deutsche Bank crunched the numbers. They projected OpenAI will burn through $143 billion before ever turning a real profit. A company setting billions of dollars on fire every 12 months just handed its largest investor the biggest profit spike in recent corporate history. OpenAI is an unemployed tenant facing eviction. Microsoft is the landlord holding the keys. Microsoft prints fake IOUs and hands them to OpenAI. Those IOUs pay for renting the servers. Microsoft legally reports that rent to Wall Street as cloud revenue growth. It is a flawless, infinite money loop until the servers actually turn on. Why can't OpenAI just build their own infrastructure? Well, the math doesn't add up. Sam Altman saw the problem. Azure's credits could never fuel the endless compute he needed, so he engineered an escape route called Project Stargate. He pitched a $500 billion master plan. He wanted independent data centers, 10 gigawatts of dedicated power. He flirted with sovereign wealth funds and foreign telecom giants. He planned to bypass the Azure ecosystem entirely, to sever the partnership. SoftBank and Oracle entered negotiations to provide alternative capital and infrastructure. Construction crews mobilized in Abilene, Texas. OpenAI prepared to build a 1.2 gigawatt facility, one site serving as the beachhead for a sprawling $665 billion infrastructure rollout through 2030. All they needed was the financing. The banks opened the disclosures, ran the numbers on the deficit, logged delays on permits, and tallied the engineer shortage to cool the massive racks. Wall Street refused the $500 billion gamble. Private investors wouldn't touch it. OpenAI quietly scrapped their master plan. They slashed the projected independent compute speed. They retreated to the existing infrastructure. They lack the capital to build their own fortresses and the margins to keep renting Microsoft servers. Azure's credit can't sustain the burn. Microsoft is left fueling a captive entity that cannot repay the principal. How does the physical hardware accelerate this crisis? Microsoft spreads its massive server costs over a 6-year accounting window. This keeps their quarterly spending low on paper, but AI doesn't wait. Frontier training models make top-tier GPUs obsolete in just 36 months. Every chip you buy today is tomorrow's legacy hardware. Imagine a delivery company buying a brand new fleet of trucks. They have to replace that entire fleet every 18 months because the old trucks suddenly cannot deliver packages fast enough. That's the economic reality of artificial intelligence hardware. Financial models from analysts expose $176 billion in hidden GPU depreciation actively decaying across the tech sector. Microsoft is booking record profits today by ignoring the physical decay of its own hardware. When the actual replacement cycle hits the balance sheet, the capital expenditure bill will explode. The models burn cash at a high velocity. OpenAI generates $12 billion in quarterly losses. Forbes estimates that the Sora video generation model alone consumes $15 million in hard cash every single day. Don't forget to like, share, and subscribe. The AI takeover isn't coming, it's already here, and we'll try to keep revealing the true story. Video generation isn't just text on steroids. Every single pixel must be calculated and rendered in sequence. It demands an exponential jump in raw computational power. Microsoft's capital expenditures surged 66% to $37.5 billion in a single quarter to feed this. The tech giant is purchasing land and pouring concrete to meet a theoretical demand that OpenAI literally can't afford to use. Taiwan's semiconductor manufacturing company, TSMC, operates as the physical brake on global artificial intelligence. They produce 90% of advanced silicon on Earth. Corporate demand outpaces their physical factory capacity by a factor of 3. You can't speed up the extreme ultraviolet lithography processes. You can't skip the chemical etching. Each chip must be born inside hyper-specialized clean rooms with perfect vacuums and extreme atmospheric control. Tech giants are sitting on billions in cash, unable to spend it, while their current servers lose value every single day. TSMC is racing to expand. They're planning a $52 to $56 billion expansion in 2026, but even that can't catch up. And it gets worse. A single gigawatt data center requires thousands of miles of thick copper wiring. Copper is running out. Mines in South America are struggling to meet demand. The cables, the power, the cooling, they all have to be perfect. One slip, one missing component, and the whole operation stalls. It's a billion-dollar waiting game. And that's not the only problem. Across the industry, data centers swallow 449 million gallons of water daily. Hyperscale facilities drain up to 5 million gallons of potable water every 24 hours just to stop the server racks from literally melting. Standard air cooling maxes out entirely at modern rack densities. The facilities need to pipe in cold water directly to the silicon chips to maintain operational temperatures. Local governments are starting to panic. Municipal water supplies are dropping while server farms keep expanding. In Florida, regulators stepped in with strict new rules to stop residents' utility bills from spiking. The legislation targets the massive energy and water demands of the new data center construction. The Midwest faces water stress. Local city councils are passing emergency moratoriums on new facility permits. They are choosing drinking water for their citizens over artificial intelligence infrastructure. The hyperscalers are being locked out of prime real estate because the local aquifer cannot support the thermal load. The hyperscalers are scrambling. They're abandoning traditional air cooling and moving to direct-to-chip liquid systems. That means ripping out entire air cooling units and bolting in metal cold plates straight onto the hottest silicon chips. Engineers need to thread miles of pressurized coolant pipes directly over racks holding billions of dollars of active hardware. The sheer material cost of this plumbing destroys the baseline construction budgets. If a single leak in a coolant line drips onto a motherboard, it destroys millions of dollars in silicon instantly. The capital required effectively doubles the initial build cost. Microsoft is footing this bill entirely up front. What happens when the hardware reaches its absolute limit? Generative AI only works as a business if the margins are massive. Those fat profits are supposed to pay for the mountains of steel, silicon, water, and electricity working away behind the curtain. OpenAI historically charged premium prices for application programming interface or API access. They utilized their monopoly position to drain enterprise budgets. The API market is turning into a commodity battlefield. OpenAI launched the GPT 5.2 frontier model and priced it at $1.75 per million input tokens. They guessed Fortune 500 companies would just absorb the cost to maintain access. They assumed the dominance would hold. They didn't expect what came next. Chinese competitors arrived. They didn't try to outspend OpenAI. They didn't build trillion-dollar server empires from scratch. They used model distillation. Instead of training artificial intelligence from scratch, they bought API access to OpenAI's best model. They asked millions of advanced math and coding questions. They captured the answers, and then they trained smaller, leaner architectures on those outputs, all without paying for the training costs. DeepSeek released their v3.2 architecture and matched the performance of the American frontier models. They dropped their exact same token package to 28 cents. Overnight, the premium collapsed. A global price war erupted. Gross margins evaporated. Developers are actively routing their daily tasks to cheaper alternatives. They use OpenAI strictly for the most complex reasoning tasks. They funnel 90% of their standard workloads to foreign models or localized open-source alternatives. This strips away the high-margin volume OpenAI desperately needs to survive. How does Microsoft respond to this revenue collapse? Microsoft is watching on as this collapse unfolds. They know OpenAI can't generate enough revenue to pay off their hidden debt. The answer is to extract the value themselves. They integrated OpenAI's tech into their own products. Copilot becomes a core part of Word, Excel, and Teams. They charge a flat $30 a month per enterprise user. 15 million people already subscribe. Wall Street assumes every $30 is pure profit. Standard software is like a printing press. Build it once, distribute it forever, and profit margins soar toward 90%. Generative AI obliterates that model. Every time someone clicks the Copilot button, a supercomputer fires up and devours energy. That $30 flat monthly fee doesn't even cover the basic electrical cost. Microsoft eats the cost to keep the customer locked into the ecosystem. They're actively subsidizing the enterprise workflows of the largest corporations on Earth. Year-over-year cloud growth slowed to 39% in the second quarter of 2025. That's below the 40% growth Wall Street demands to justify the $3 trillion valuation. Profit margins are under pressure, sliding from a strong 46.7% to unsustainable levels. Microsoft is utilizing the most expensive computational infrastructure in human history to draft basic corporate emails. If they raise the price of Copilot, clients will turn to cheaper alternatives. If they keep the price at $30, the power users consume the server capacity. If they restrict the Azure capacity for Copilot, the software experience degrades instantly. Where does the breaking point occur? Standard venture capital can't touch this deficit. Silicon Valley doesn't have the liquidity to cover a hole this massive. They need a single entity capable of writing a $50 billion check in one afternoon. In January 2026, Sam Altman flew to the United Arab Emirates. He pitched an $830 billion corporate valuation to sovereign wealth funds in Abu Dhabi and requested $50 billion in hard cash. It was a Hail Mary to keep the existing Azure servers running and bypass the domestic banking system entirely. The Committee on Foreign Investment in the United States watches every move. The Pentagon classifies frontier AI as critical national security infrastructure. It's seen as a weapons system. Middle Eastern funds are blocked instantly. The government previously forced a Saudi fund to completely divest and exit an Altman-backed artificial intelligence chip startup. OpenAI is being starved of domestic liquidity and barred from accepting foreign sovereign bailouts. Every lifeline has been cut. The fallout in the bond market was swift. Microsoft officially carries $100 billion in debt. Investors recalculated the risk premium. Azure's growth slowed, and 45% of future revenue is locked into a single unprofitable tenant. They watched $12.7 billion vanish in shareholder payouts, while the data centers burned cash at record rates. Treasury yields climbed to 4.08%. Suddenly, cheap capital disappeared. Every new facility had to prove immediate profitability, something OpenAI couldn't guarantee. And just like that, expansion froze. The data halls began to implode. The sheer scale of the operational bleed has caused an internal panic. Compute access has been throttled to survive the cash crunch. ChatGPT responses lag for everyday users. The revenue curve has flatlined. They were cornered. So, in late February, OpenAI did the unthinkable. They betrayed Microsoft. In a desperate bid to keep the lights on, Sam Altman secured a $110 billion bailout led by Amazon, Nvidia, and SoftBank. But this isn't a victory for Microsoft, it's a hostage situation. To get Amazon's $50 billion, OpenAI had to agree to plow huge amounts of money into Amazon Web Services. They are cannibalizing Azure. The flawless infinite money loop is officially broken. Microsoft is left holding the bag on billions in decaying hardware, while their unemployed tenant packs up and moves across the street. Microsoft fed OpenAI billions in fake digital credits. OpenAI returned the favor by walking away, leaving Microsoft with billions in real physical liabilities. The accounting tricks were merely smoke and mirrors. OpenAI betraying Microsoft and pulling them down is just the first domino. Wall Street is looking at software, but the companies building the physical AI hardware are hiding a completely different, much deadlier financial secret. The cracks in that foundation are already tearing open right here. The divorce might not be finalized, but they are spending time apart. Now Microsoft is left thinking about what could have been. You're already being replaced, you just haven't noticed it yet. Artificial intelligence was sold as a harmless assistant, a tool to make life easier, work faster and smarter. But they are quietly learning how to do your job. While you were saving time, AI was learning to replace you. Tech bosses want to usher in a so-called intelligence age, where machines will take on all the hard, boring, dangerous work. Humans, meanwhile, will be free to chase exciting new opportunities. But beneath that shiny promise lies a darker truth. Behind the scenes, your skills are being erased, your experience worthless, your future already written, and it doesn't include you. This is the OpenAI lie, and if it succeeds, it won't just change work, it will break society. Chapter 1. The Death of the Resume. The working world has changed, but one thing has always stayed constant: the resume. Every line, every achievement, every late night and early morning is proof that you fought to get where you are. It's more than a piece of paper, it's your story. You rely on it to open doors, to earn respect, to claim the opportunities you've earned. And now, it's under attack. Sam Altman and the other Silicon Valley CEOs don't care about your skills that you've spent years mastering. They'll be meaningless once AI agents have already learned them. The subjects you've paid thousands to study in college won't impress anyone when large language models can recite every detail on demand. The hours that you've poured into climbing the corporate ladder mean nothing against an all-powerful, all-knowing AI that operates around the clock. It can do anything you can do, faster, cheaper, and more efficiently. This is the future that OpenAI and other companies are racing toward building, except they don't see it that way. To them, the rise of artificial general intelligence, or AGI, is something to celebrate. This next-level AI won't just assist, it'll think like a human. It'll move seamlessly from one industry to another, solving problems and, in OpenAI's own words, outperforming humans at most economically valuable work. In other words, anything people can do, AGI will be able to do better. And this isn't some far-off science fiction dream, it's a countdown that began in 2024. OpenAI expects to achieve its aims by 2030, and Sam Altman could not be more excited. In his own manifesto shared online in a September 2024 blog post entitled The Intelligence Age, Sam Altman says, "I believe the future is going to be so bright that no one can do it justice by trying to write about it now. A defining characteristic of the intelligence age will be massive prosperity." He talks about fixing problems that have plagued mankind for generations, of achieving things that humanity has only dreamed of, fixing the climate crisis, creating colonies in space, making game-changing breakthroughs in science. He also tries to calm any fears about AGI, claiming history always replaces old jobs with new ones whenever technology advances. But this time it won't be so simple. Jobs won't be replaced or lost, they will just change. He adds that he has no fear that we'll run out of things to do because people have an innate desire to create. AI will allow us to amplify our own abilities like never before. Altman sells his vision well, but look closer, and the cracks are clear to see. Let's say Altman gets what he craves and AGI takes over all that economically valuable work. What happens to the graduate, the white-collar worker, the entry-level employee struggling to just get a foot on the ladder? Well, they don't fit into OpenAI's vision of the future. Because if a machine can do the work of a junior associate or entry-level employee for a fraction of the price, then that employee is no longer an asset, they're a liability. Altman wants to frame this as liberation, a world where humans can pursue creativity while machines handle all the boring work. They claim to be building a tool that will both empower and outperform humanity. Do you see the problem? Those two ideas can't realistically coexist. You can't empower a worker by making their core skill set entirely obsolete, and you can't build an economy by removing the ways people actually earn money. OpenAI's 2030 AGI prediction suggests the software to power it must already exist, but the hardware, that's a different story. Chapter 2. The Mathematical Mirage. The AI world lives and dies by scaling laws. Basically, if you add more data and more processing power, what they call compute, AI gets smarter and more capable. In theory, there is no ceiling to this. Companies can just keep feeding it more data, more compute, year after year, watching their models reach new levels of genius. OpenAI has already admitted that AGI will take enormous amounts of resources. Altman has spoken about buying up vast amounts of energy and chips to build massive computer clusters. The goal is to drive down the cost of computation until it becomes effectively unlimited, abundant, cheap, and everywhere. Again, it sounds perfect, almost utopian. But it's an illusion, a pipe dream. To power its AGI revolution, OpenAI is going all in on the so-called Stargate project. It's a joint venture to build a whole new AI infrastructure for OpenAI in the US. They're starting with an eye-watering $100 billion poured into a massive supercomputer cluster. And that's only step one of the long-term Stargate vision, which is eventually set to cost $500 billion by 2030. And that's because AI is insatiable. It's always wanting more data, more resources, more power. According to some experts, if OpenAI keeps going at its current pace, it'll need 10 times more data and 100 times more compute every 2 years. That means billions more poured into data centers, energy, and hardware. Even the richest economies would struggle to sustain that. And OpenAI isn't a wealthy nation. It's not even a profitable business. It currently operates on a massive deficit with a 2024 revenue of $3.4 billion and a loss of $5 billion. The company is incinerating cash. To put it into perspective, that $5 billion loss is equal to the entire GDP of countries like Liberia, Suriname, Greenland, or several Caribbean nations. One single company burning through the same amount of money that powers entire national economies every year. That is not sustainable. It's desperate. Thinking more long-term, Altman has even spoken about a $7 trillion investment being required to construct a global chip-building initiative. That's around 7% of the world's entire GDP. All of this, billions spent, supercomputers built, energy consumed, in the hope that it's enough to achieve AGI. And then somehow it'll generate enough wealth to repay those billions and billions more of investment. It's a gamble. One the world has never seen before, and one that Silicon Valley loves to take. Parts of the tech industry run on blitz scaling, the idea that you lose money up front to build your product and capture the market. The hope is one day you'll raise prices and rake in the profits once the initial chaos is over. Except you can't blitz scale the laws of physics. It relies on a physical miracle. The idea that high-end semiconductors and computational resources can scale tenfold in less than a decade. It's not feasible, and it's never going to happen. And we haven't even touched on the energy demands of the AGI revolution yet. Chapter 3. Powering a Digital God. Even if the massive clusters needed for AGI are built, how do you power it all? The digital world isn't exactly weightless. It depends on hardware that has to be plugged in and powered, only on a scale that is millions of times greater. It's estimated that a single ChatGPT query uses around 10 times more electricity than a Google search. That's about the same amount of power needed to power a small LED light bulb for about 20 minutes. Now, scale that up. Scale it across billions of users, millions of queries, every single hour. The result? An energy demand unlike anything the world has ever seen, far beyond what today's electrical grid can handle. Rene Haas, the CEO of British semiconductor and software design company ARM Holdings, believes that AI data centers could eat up to 25% of the US's entire power supply by 2030. At the moment, AI uses just 4% of America's supply. Other experts agree, arguing that the US needs to expand its power grid capacity by around 20% just to keep up with the ever-expanding AI industry. In real terms, that would be like the US having to add the entire power generation capacity of a major European nation like Germany to its grid in less than a decade. Again, this isn't just ambitious, it is impossible. Power plants don't just appear overnight. Nuclear reactors, the only carbon-free source capable of delivering this kind of massive power, can take over a decade to build, sometimes even longer thanks to regulations, delays, and unexpected construction hurdles. Tech billionaires know this, but they also seem to believe they could bend or break the rules to just get what they want. Microsoft is attempting to restart the 3 Mile Island nuclear plant project to help feed AI's insatiable appetite. It's another desperate act. A clear sign that without a massive private power supply, the intelligence age has zero chance of arriving by 2030. And electricity isn't the only problem. A single data center requires millions of high-voltage copper cables and huge electrical transformers. The global copper supply chain is already stretched due to other industries and the surge in electric vehicles. Experts predict it'll hit full capacity by the late 2020s, and it'll still be up at least 10% short of global demand. The world still doesn't have enough raw materials to fuel the AGI push. This isn't conjecture, it's fact. Václav Smil is one of the world's leading energy experts. He spent decades studying energy transitions, and he knows how slow they actually are. They don't take years, they take generations. As Smil warns, Silicon Valley's would-be masters of the universe have discovered that energy transitions are subject to time spans and technical constraints that defy their reach. But if Altman and OpenAI know that an energy revolution can't be forced with money alone, why keep promising 2030? What are they really building toward with this infrastructure race? Chapter 4. The Compute Gentry. This is where things start to get worrying. History shows that when a new means of production emerges, power rarely spreads. It remains in the hands of a few. The age of steam had its steel barons. The internet age was dominated by ISPs. Now in the age of AI, power won't be measured in barrels of oil or dollars. It'll be measured in flops, floating point operations per second. Whoever controls the compute controls the future. And that means a new elite class will be born, the so-called compute gentry. Leopold Aschenbrenner, a former OpenAI researcher, has been sounding the alarm. In a report called Situational Awareness, he lays out the troubling geopolitical realities behind the AI race. He warns that the physical demands of AGI are so huge that only a handful of the world's wealthiest companies will be able to take part. And it's not only inevitable, it's already happening. Aschenbrenner says, by 27 or 28, the endgame will be on. By 28-29, the intelligence explosion will be underway. By 2030, we will have summoned superintelligence in all its power and might. The risk of it all going, in Aschenbrenner's words, off the rails will be constant. Analysts fear a world where so much power rests in the hands of just a few megacorporations. If OpenAI and other tech giants succeed, they will control the very means of production for intelligence itself. And we will never have seen anything like it. The smarter this tech gets, the more expensive it becomes to train and maintain. That only raises the entry barrier. The result will be a kind of feudal system. Anyone wanting to run a business or offer a service will have to rent intelligence from the compute gentry. Because whoever owns the intelligence that replaces labor owns the economic output of the human race. This goes entirely against OpenAI's original founding philosophy. The company began as a nonprofit. Its charter was to ensure that AGI would benefit all of humanity. It promised openness, transparency, and guardrails at every step. That charter has changed. The company has restructured into a for-profit entity. The guardrails are gone. Their mission is no longer about bettering humanity. It's all about profit. And this, more than anything else, highlights the crux of OpenAI's AGI lie. It claims that this technology will be a public good, that it'll bring about a brighter and more prosperous era for everyone. Meanwhile, what OpenAI is actually doing is building its own private fortress and throwing away the key. Chapter 5: The Corporate Sovereign. The end goal of this AGI era is the restructuring of society as we know it. Altman wants people to believe that this is all being done with their best intentions at heart. He has spoken on several occasions about the prospect of a universal basic income. It would be the obvious antidote to any risk of large-scale job loss and unemployment brought about by hyper-intelligent AI. But that logic is flawed. If AGI replaces the human workforce, the tax base of every democratic country collapses. No human income means no taxes. No taxes means governments won't have the money to provide universal basic income to millions. Instead, the power will become even more concentrated. And it won't be a government writing your UBI check. It'll be a corporation. That same corporation that owns the algorithm that replaced you. This is the definition of algorithmic feudalism. It is a terrifying but realistic prospect. The public can't vote for CEOs. They can't lobby black box algorithms. Democracy depends on the economic independence of the people. But when people are entirely dependent on corporate entities to give them the money they need to feed their families, they're no longer economically independent. They are subjects. OpenAI argues that it'll all work. Altman talks of changing jobs and new opportunities. But he doesn't go into specifics. He doesn't explain why a for-profit corporation would decide to simply give away its primary source of power and income. Worst of all, Altman's Intelligence Age Manifesto ignores something fundamental: the long-standing social contract between the people and those in power. It assumes that you'll simply accept your loss of agency, that you'll simply nod and smile as your career, your privacy, and your democratic rights are stripped away in the name of superintelligent AI agents. Society is being restructured, not with votes or referendums, but by the pursuit of a digital god. The Stargate project, the $7 trillion chip plan, the insatiable demand for energy, those aren't isolated events. They're all links in a chain of a new world order. A world where intelligence is a centralized commodity, where human labor is obsolete, and the computer gentry are the kings and queens of it all. The AGI lie isn't that this technology won't work. The lie is that it is being built for you. This technology isn't being made for the people. It's being made to replace them. The only question left is there any way to stop it? This is Josh, and today on the Infographic Show, we're going to talk about why OpenAI will run out of money, but not for the reason you think. The creator of ChatGPT looks like the king of tech with $20 billion in revenue, but internal spreadsheets reveal something startling. Starting in 2026, they face projected losses of $14 billion annually. By 2029, cumulative spending could hit $115 billion. The product works, but the bills are tied to expensive, real-world constraints. Here's the thing that most people miss. The massive losses lie in a simple fact: AI is not just another app, and it behaves unlike any software we have ever built. In the traditional software world, if you want to make a better app, you hire better engineers. You write cleaner code. It's a human cost. But AI doesn't work like that. It works on something called scaling laws. These are mathematical rules that govern how AI gets smarter, and they are incredibly expensive. The rules are simple. If you want a model to be, say, twice as good, you can't just double your effort. You have to ramp up computing power by a lot. It's basically a brute force equation. Small gains in intelligence mean massive spikes in capital. It sounds crazy, right? But wait until you see the numbers. Training GPT-4, the model that really kicked off the revolution, cost roughly $100 million in computing power. That is for one full training run, which is the process of teaching the model from scratch. For a big tech company, that is expensive but manageable. The next generation, the frontier models arriving in 2026 and 2027, play by different rules. Each run could cost over $1 billion. We have reached a point where a single training session for one AI model costs more than the GDP of some small island nations. And it gets worse. You can't just train it once and walk away. You have to keep on doing it. OpenAI is trapped in a cycle where they must spend these billions of dollars just to stay slightly ahead of their rivals who are giving similar tech away for free. This creates a fundamental gap in their business model. Their costs are tied to physical realities, electricity and silicon, which are expensive and scarce. But their ability to raise prices is limited because there's so much competition. The math is simple and it is catastrophic. Explosive costs are outpacing revenue and the money is running out. And the financial bleed gets even worse. To do the heavy lifting, OpenAI needs high-end AI chips like Nvidia's Blackwell B200s. These aren't your typical CPUs or GPUs. Each one runs $30,000 to $40,000. And you can't buy just one. To train a frontier model, you need a cluster. That means tens of thousands of these chips, all wired together with high-speed links and liquid cooling systems. And this is where the costs really start to pile up. But the problem isn't just buying the chips. The problem is that these chips have a limited shelf life. Unlike a machine in a factory or a delivery truck, which might run for 20 years, AI hardware doesn't last. It becomes outdated the moment the next generation of chips hits the market, and then companies are playing catch-up. OpenAI has to replace their entire system of chips roughly every 18 months to 3 years just to stay competitive with Google and Meta. Imagine a trucking company having to buy a brand new fleet every 18 months because the old trucks suddenly can't deliver packages fast enough. That is the economic reality of AI hardware. This means the billions of dollars OpenAI spends on hardware isn't a long-term investment. It's an expense that disappears. The value of that hardware drops fast. But if the cost of the chips wasn't enough, there is another bill that's starting to look even scarier: the electric bill. This is best illustrated by Project Stargate. It's described as just a big new supercomputer, but it's actually a $500 billion gamble. $500 billion, yeah, that's right. To put that into perspective, 10 gigawatts could power millions of homes. It's the equivalent of multiple full-scale nuclear reactors just for this one project. Why does this matter? Because the costs aren't going away, and the grid can't keep up. The scaling costs aren't going away, they're fixed. You can't build the next generation of AI without this level of power. The bottleneck isn't just the cost of electricity, it is the national grid. Getting enough high-voltage transformers and grid capacity is a huge hurdle. The old utility system can't grow fast enough to keep up. So OpenAI is now in the position of negotiating for direct access to nuclear power and massive solar farms. These utility costs create a high floor for their operating expenses. Every free ChatGPT user is literally costing billions, and there is no way around it. It makes it nearly impossible to maintain healthy profits when you are trying to offer a free tier to hundreds of millions of users. Every time someone uses ChatGPT for free, OpenAI has to pay for the electricity and the silicon wear and tear. So if OpenAI is losing billions of dollars on chips and electricity, how are they still open? How do they pay their employees? And that leads us to one of the most misunderstood pieces of the OpenAI story: its deal with Microsoft. We often hear that Microsoft has invested billions into OpenAI, and on paper, it looks like billions came in. In reality, it's more like a financial merry-go-round that hides how tight the startup's cash really is. When Microsoft invests billions, a lot of that money doesn't actually leave Microsoft. They give OpenAI cloud credits instead, sort of like a gift card. And you might think that that counts as real cash. It doesn't. OpenAI can record it as capital raised, so it looks like cash, but the credits have to be spent on Azure, Microsoft's cloud service, to run their models. This effectively recycles the investment back into Microsoft's revenue stream. It boosts Microsoft's cloud earnings and stock price. But here's the dangerous part: you cannot pay your employees with cloud credits. When OpenAI hires a top researcher for $2 million a year, they need hard cash. When they have to pay for office space or legal fees, they need money. This creates a financial optical illusion. Microsoft invests $10 billion, but that money doesn't actually land in OpenAI's account. It's basically digital coupons that can only be spent on Microsoft servers. The result is massive pressure. Every fiscal quarter, OpenAI has to raise hard cash from other investors just to pay payroll and cover bills that Microsoft credits can't touch. If the flow of new outside investment slows down, OpenAI faces a cash flow crisis. They might have plenty of computer time, but not enough hard currency to keep their team from leaving for rival companies. Despite all those costs, investors keep on pouring money in. In March 2025, OpenAI managed to raise $40 billion, the largest private funding round in history, even bigger than the IPO of the oil giant Saudi Aramco. But here is what is really odd about it. Saudi Aramco has hundreds of billions in revenue, and more importantly, it has real tangible assets, oil reserves that you can measure and sell. OpenAI is a startup with no profits, burning cash at a rate of billions a year. Its value is mostly intellectual property, which anyone can try to copy. So what does this mean for the long-term survival of OpenAI? The answer will surprise you. Investors are pouring money in based on the promise of a market that doesn't fully exist yet. For OpenAI to be worth $1 trillion, it can't just be impressive, it has to replace dozens of cheaper tools that companies already use. Right now, most businesses spread their AI budgets across multiple smaller providers, not just one giant system. OpenAI is building something massive and expensive, betting that eventually everyone will need it. But right now, there's no guarantee of that demand. And this leads us to the risky business model. In software, companies survive by making it hard for customers to leave. Salesforce does this because moving all your data is a huge pain. Netflix does this because they own shows that you can't watch anywhere else. OpenAI is discovering a hard lesson. Users are mercenary. If Google's Gemini or Meta's Llama offers a similar answer for cheaper, they'll leave instantly. About 75% of OpenAI's revenue comes from consumer subscriptions, but the number of cancellations is rising. And once the novelty fades, most users won't pay. Big business is even more skeptical. Only about 20 to 30% are sticking with OpenAI's API long-term. Many are choosing open-source models like Llama to keep data private and costs down. With nothing keeping them tied to OpenAI, no built-in network, no way their data is stuck, they could just jump to another provider overnight. And the competition is just as deadly as OpenAI's own cash burn. Meta's decision to release the Llama models for free was not an act of charity, it was a tactical strike. When Mark Zuckerberg gives everyone access to their top-of-the-line AI for free, he effectively sets a ceiling on what OpenAI can charge. Meta can burn cash on open-source models because they're using the tech to improve ads on Instagram and Facebook. Their business isn't selling AI, it is selling ads. OpenAI doesn't have that luxury. Their only product is the AI itself. They're fighting to establish themselves while their competitors aggressively undercut the market to keep them from gaining ground. And the clock is ticking. OpenAI is squeezed from all sides. On top, giants like Microsoft and Google with practically unlimited cash. On the bottom, lean competitors like Anthropic and Mistral. Anthropic runs a much more efficient operation, focusing on safety and enterprise reliability with a much lower burn rate. Meanwhile, Google's DeepMind keeps stealing talent, forcing OpenAI to offer massive stock-based pay packages. Those only work if the company's valuation keeps climbing. If it stalls, the researchers, the company's only real asset, could walk out the door. As if burning billions, fighting competitors, and losing talent weren't enough, regulators in Washington and Brussels are circling. In early 2026, the FTC and European Union intensified their antitrust probes into the Microsoft-OpenAI partnership. Regulators are checking whether Microsoft's investment is actually a de facto acquisition designed to skirt merger laws. If they decide to limit the power Microsoft has over OpenAI or force a split, it would cut the startup's financial lifeline. And then there's the mounting geopolitical friction. Export controls on AI chips are shrinking the global market, while new AI safety regulations are creating a massive compliance burden. OpenAI now needs armies of lawyers and safety researchers, roles that are costly and generate zero revenue. The danger becomes clear when you look at history. Uber lost billions before its initial public offering or IPO, but it was building a physical network in thousands of cities. Tesla struggled for years, but it was building factories and a global charging network, something real that competitors couldn't copy overnight. OpenAI, well, it's burning billions with no real network or physical assets to lean on. OpenAI's production is all about raw computing power, the expensive chips that mostly come from Nvidia. Unlike Tesla or Uber, OpenAI's product loses money every time someone asks it a complex question. And there is nothing stopping users from leaving tomorrow. The company is now effectively betting everything on a single desperate timeline. They're racing to build artificial general intelligence, or AGI, an AI that can think and learn like a human before the bank account runs out. This isn't a standard software business strategy anymore. If OpenAI can build a model smart enough to do the work of a human expert in any field, their current cash burn wouldn't matter. Revenue could, in theory, skyrocket. They're picturing a world where their AI doesn't just summarize emails, it replaces entire departments, handling corporate taxes, writing complex code, and planning strategic business moves at superhuman speed. Reach that milestone and they could charge a premium that covers any debt, no matter how massive. If OpenAI is losing $14 to $17 billion a year, every month of delay costs over $1 billion. If the breakthrough to AGI takes 5 years instead of 2, they'd face a funding gap of nearly $100 billion just to keep the lights on. And no investor can fix that overnight. So what happens when the money runs out? You might expect a dramatic crash, but the reality is different. The most likely outcome is not a dramatic crash or a bankruptcy filing, but a quiet absorption. By mid-2027, based on current projections, the cash reserves raised in the 2025 rounds will be nearly empty. At that point, OpenAI will face a choice: raise another massive round at a lower valuation, crushing their employee stock options, or sell. Microsoft is the natural and maybe the only buyer. They already host OpenAI systems on Azure and they have deep integration with the software. More importantly, Microsoft has over $80 billion in cash reserves, making them one of the few entities on Earth that could sustain OpenAI's burn rate. For Microsoft, this is the crown jewel, the engine of the next computing era. For investors, it's a fire sale, but one that buys survival. This is the end of the startup frontier. OpenAI proved scaling works, but only if you have a nation-state-sized budget. The AI revolution has gone industrial, where success is measured in acres of data centers, not lines of code. OpenAI started the trend, but it doesn't have the resources to compete alone. You were promised infinite intelligence for just $20 a month. That promise is already breaking. AI was supposed to be as cheap and limitless as electricity, but now Silicon Valley is pulling it back. Across models and platforms, users are now facing tighter message caps and shrinking access. It's like an all-you-can-eat buffet, where you're told you get one bite every few hours. The era of infinite AI is fading. The reason is a frantic new game inside big tech called token maxing. So if AI is getting more powerful, why is access getting smaller? For a while, anyone paying for ChatGPT Plus could open OpenAI's newest reasoning model, O1 Preview, and use it as and when required. Then in September 2024, a new limit was set, just 50 messages a week. For the people paying the most, that came out to a handful of real conversations spread out across 7 days. Compared to the previous generation of models, it was a cut of roughly 98%. Once the quota ran dry, the screen stopped. There was a way to bypass this, but it came with a price. In December 2024, OpenAI introduced a tier called ChatGPT Pro at $200 a month, 10 times the cost of Plus. It came with near unlimited use of the very model everyone else was now being rationed on. Unlimited intelligence still existed, it simply had moved behind a much bigger paywall. OpenAI framed the move as housekeeping, a way to protect the quality of the service. But for the people who had built it into their daily work, it felt like a tool had suddenly been pulled out of reach without much warning. The model wasn't gone, but it was harder to get to. People started rationing themselves. They hoarded their most difficult questions or work for the hour the quota reset, and then if they ran out, they would just stop and wait. The companies that had spent years talking about intelligence getting cheaper and more widely available were restricting access to the very thing they sold as the future. The gap between the big promises and what people were actually using was hard to ignore. The reason was obvious. Running these models at full capacity, the way the industry had scaled them, wasn't adding up financially anymore. So big tech came up with the perfect workaround: token maxing. A token is just a scrap of language, a word, a small step in the machine's train of thought. So when you can no longer make a model smarter the old way, you make it work harder. You force it to chew through far more words or tokens for the very same answer. Instead of giving an instant reply, the system now talks to itself first, privately, at length. This can be tens of thousands of words before a single sentence ever reaches your screen. And instead of learning only from what humans wrote, the newest models are fed enormous piles of text that older models generated. The whole point is to keep the curve from going flat by shoving more and more compute through the same machine. The scale is mind-blowing. Meta's Llama 3 ate through more than 15 trillion tokens of text, about 7 times the data used on the version before it. Stack that human equivalent on a bookcase shelf, and it would be close to 1,800 miles long. Token maxing takes that number and piles more on top of it. Models loop through their old output for every hard question they're asked. It sounds like a good idea. More intelligence is squeezed out of the same chips, with no new supercomputer required. The longer the machine talks to itself, the more it can check its own work, try an idea, and then throw it away. The extra thinking is bought one word at a time. All you see is a brief pause and then the answer. But this was never a success to be heralded. It was born out of sheer panic. Something in the AI world had broken, and people closest to it knew exactly what it was. For 10 years, the whole industry ran on one core belief: multiply the computing power by 10 and the model gets dramatically smarter. More compute means more capability year after year after year. Entire business models were gambled on this assumption. The results said different. Inside multiple labs, the data said the same thing. A 10 times jump in compute was only producing marginal gains, around 10 to 15%, sometimes less. What used to buy a leap in intelligence was now buying a sliver of improvement. OpenAI saw it firsthand. The model supposed to be its next leap forward, codenamed Orion, reached the level of the previous flagship after only a fraction of its training. Then it stalled. The people who tested it said the improvements were smaller than expected. When it finally shipped, it wasn't the long-promised GPT-5, but GPT 4.5, a downgrade in name that said everything. Not everyone agreed. When news of the slowdown leaked in 2024, OpenAI chief Sam Altman publicly dismissed them. "There is no wall," he said. The researcher Gary Marcus shot back that the limitations had been obvious for months. Even Andreessen Horowitz, with billions riding on the outcome, admitted that more computing power was no longer delivering the same leaps in intelligence. To some, it was a temporary plateau. To others, the end of an era. Either way, the money kept flowing, just in a different direction. In public, the message remained the same. Progress was just around the corner. In private, more and more people were coming to the same conclusion. The strategy that had fueled a decade of breakthroughs was running out of room, and the next gains would have to come after training. The early jumps were hard to miss. Each new model seemed smarter than the last. It was obvious to anyone who used them. The newer releases felt different. Better, yes. Smoother and more reliable, but not the kind of leap that justified the billions being spent. Admitting that would have meant questioning the foundations the entire industry was built on. So the industry grabbed onto the one thing that still seemed to work: giving models more tokens. Back when models were smaller and answering a question cost next to nothing, ChatGPT launched at $20 a month. It was set when AI was cheaper to run, and years later it is still the same price. The economics, though, had changed completely. Some of the most active users were costing OpenAI more than $120 a month in computing power while paying just $20 for the privilege. Every one of those users deepened the gap between what the service cost and what it charged. It's like a grocery store treating a loyal customer well and then slipping them a $100 bill on the way out the door. It doesn't stop there. It looks for 1,000 more customers exactly like them. The more people who fall in love with the product, the faster the cash burns away. This is not a rough patch that fixes itself. It's baked into the system. Every time the model stops to think a little longer, the bill goes up. What used to be a quick response can turn into a long chain of reasoning running behind the scenes before the answer ever reaches the user. That's great for accuracy. It's less great for cost. The hardest questions demand the most compute, and those are exactly the questions people come to the best models to solve. It affects the whole industry. The chips were bought and the data centers went up, but the revenue to justify them has yet to arrive. In 2024, the venture firm Sequoia framed it as AI's $600 billion question: the distance between the tens of billions being poured into AI hardware and the money the industry could ever earn back. Those data centers need hundreds of billions a year just to break even, and subscriptions cover only a small portion. Adding more $20 subscribers can't close it, because every new heavy user only adds to the problem. So the cap makes sense. Letting everyone run the most powerful model all day was never going to work. The numbers don't allow it, so the most expensive workloads are increasingly being pushed toward higher-priced tiers and enterprise customers, where the economics make sense. Corporate contracts can hide the cost of a top model inside the hours it saves and the staff it replaces. A single $20 subscriber can't. From the perspective of the labs, that subscriber was never the real customer. They were the proof the product worked, the hype that made the enterprise deals possible, a deliberate loss-making base scaled to a level the industry has never tried before. Money was only part of the issue. The bigger problem is that all the labs are starting to run low on the very thing needed to build the next generation at all. But what happens when scaling stops delivering and a deadline is beginning to loom? There's only a finite amount of writing in the world. It sounds strange to say, but it is true. Strip out the spam and low-quality slop, and the amount of genuinely useful human-written text left on the internet shrinks fast. Researchers at Epoch AI estimated at roughly 300 trillion tokens. At the fastest training schedules, that supply could be mostly gone by 2026, with most projections landing around 2028. A few years after that, it runs dry entirely. But not all of it is equally valuable. The best material got used up first. The carefully edited books, quality journalism, peer-reviewed research. A lot of it has already been seen multiple times in training runs. What's left is everyday web pages that add less and less each time you go back to them. This isn't something you solve by scraping more pages. The human text that drove the last big jumps is running out, and it's not being replaced fast enough to keep up. So the industry turned to the only source that still looked bottomless: the machines themselves. If humans ran out of words, let the machines write their own and feed those to the next model, close the loop, and let the machine teach the machine. It has been tried. What happens next is called model collapse. And in 2024, the journal Nature published the autopsy. Train each new generation mostly on machine-made text, and it rots in a very specific way. The range of what it can say shrinks inward. The identity and personality that exists in real human writing fades out of every new version. The model drifts toward a flatter, more repetitive copy of itself. And it only gets worse. The Nature team fed a model a passage about medieval church towers, trained the next version on its answers, and then the next on those, over and over. By the 9th generation, the model had forgotten the question entirely and was discussing jackrabbits, in a passage that had started out about architecture. Each generation trained on the last drifts a little further from the real thing, and pouring in more machine text does not stop the decline. It speeds it up, dragging the system toward a flat, hollowed-out echo of what it once knew. Even slipping a little human writing back into the mix can't save it. The machine-made portion sneaks in errors that are almost impossible to find. Eventually, the model starts to trust its own guesses as fact, doubling down on its blind spots, repeating its own mistakes, and poisoning the well it drinks from. There is no escape from it. If more data only makes things worse, what happens when AI runs into the physical limits of the world itself? Just outside Loudoun County in Northern Virginia, miles and miles of windowless buildings dominate the landscape. It might sound like an unremarkable place, but it's estimated that 70% of global internet traffic flows right through here. Data centers brought in roughly $875 million in tax revenue for the county in 2024 alone, enough to fund schools and build roads. It's become the densest concentration of AI hardware on the planet, and the amount of power flowing into it has reached the scale that is hard to grasp. A few years ago, a large data center might have asked the grid for around 30 megawatts of power. Today, a single campus can ask for hundreds. The biggest ones now push toward gigawatts. That's so much electricity that one site can draw the output of 2 full nuclear power plants. That power has already been requested and approved. What's missing is the infrastructure to move it. Dominion Energy, the utility behind most of the region, has publicly stated it can't deliver new capacity on the expected timelines. Getting a large site connected can now take 4 to 7 years, and getting it into the queue for review takes longer than that. The bottleneck is no longer chips or models, it's the physical grid. Token maxing just makes it worse. Every advanced query runs longer than the simple chatbots that came before it. That means a longer drain on the energy grid. So even if the data never ran out and the models never decayed, the power to supply them would be locked behind permits and an imaginary infrastructure. It puts a hard ceiling on how many AI projects can come online at one time. If the system can't expand fast enough for everyone, what decides who gets in and who doesn't? The best AI won't end up as a cheap utility for everyone. It'll go to whoever can afford what it actually costs to run. The simpler models will stay widely available because they're cheap enough for companies to absorb. But the systems that think longer and spend more compute per answer will be pushed into higher and higher tiers, reserved for customers who can cover the costs attached to them. Over time, the gap between those two worlds will widen as the cost of the most capable systems keeps rising. The top tiers will carry prices that match real computing. It wouldn't be a marketing-friendly price. Corporations will keep signing bigger and bigger contracts because they can spread the cost. Anyone who relies on the best model for serious work will need to ask if it's really worth the price tag. The promise sold to the world was simple: AI would get cheaper every year until it became universally available. What's emerging instead is something else, a system where the best models are deliberately limited. For companies, it's economics. For users capped without warning, it feels like an exclusion. There is no universal AI anymore. There are tiers of it. AI models aren't just changing subscriptions, they're reshaping careers. As machine learning scales up, the next generation of workers is feeling it first. The computer you've used for years is disappearing. That screen, the icons, the windows, the menus you click, they're all being forced into the background. They're being replaced by a $70 billion transistor black box that makes more and more decisions for you and charges an energy tax every time it does. Nvidia isn't just releasing a new chip. They're trying to do to the CPU what they already did to the GPU. And Microsoft just handed them the keys. A laptop sitting on a store shelf isn't really a computer in the traditional sense anymore. Sure, it looks like one, it turns on like one, but the architecture that defined personal computing for decades is starting to disappear. At the center is a chip Nvidia calls RTX Spark. For years, computers were built from separate parts: a CPU for logic, a GPU for graphics, and increasingly dedicated hardware for AI. Data constantly moved between them. Nvidia reduced all of that onto a single piece of silicon. The result behaves less like a collection of components and more like a single computing organism. Everything shares the same memory, everything works from the same pool of data. Nvidia says it can perform 1,000 trillion calculations every second. That number itself doesn't even matter, it's all about the results. A thin laptop with all-day battery life can now run an AI model with 120 billion separate settings inside of it. Work that once filled a room now fits in a backpack. Nvidia claims it'll turn the PC from a tool to a teammate, and they aren't doing it alone. Microsoft willingly supplied the missing piece, the software that lets an AI agent hijack your computer. It watches across your apps, it acts before you ask. The desktop, the icons, and the files and folders you've used your whole life are still there. They're just no longer in charge. For 2 generations, the CPU sat at the center of personal computing. Now it's just the supporting cast, and the company whose name was stamped inside almost every computer on Earth didn't lose this battle on your desktop. It lost it somewhere much bigger. For 3 decades, Intel was at the center of the digital world. Its chips powered everything, from office equipment to massive server farms behind nearly every website you've ever opened. If computing had a bleeding heart, Intel was it. Then the floor gave way. Between 2021 and 2025, Intel's share of the data center chip market collapsed from roughly 68% to around 6%. At the same time, Nvidia surged to 86%. One company practically took over the market. By June 2026, Nvidia was worth in the region of $5 trillion. It was the most valuable company on the planet. No business in history had ever been valued that highly, and no one's came close. When the RTX Spark was unveiled, the markets reacted immediately. Nvidia's stock jumped while shares in AMD, Intel, and Qualcomm all fell. For decades, Intel and AMD built chips around a design called x86. Its strength was running instructions one after the other as fast as possible. That is just what traditional software needed. AI plays a completely different game. Instead of a long chain of instructions, it performs enormous amounts of simple math all at once. This is where Nvidia had a head start. Its graphics chips were already built to solve thousands of problems at the same time. That is what rendering a video game requires. When AI became the most important thing in computing, Nvidia didn't have to reinvent itself. The future was already optimized. Intel realized the threat and fought back. It built AI accelerators and launched competing products. It spent years desperately trying to close the gap. The gap kept growing. The company that had spent decades setting the pace for the industry was now struggling to keep up with it. None of that was luck or clever marketing. It was the work that changed everything. Nvidia was already waiting. Jensen Huang called it a reinvention of the computer as significant as the day the phone became the smartphone. But winning the data center wasn't enough. To take over the computer on your desk, Nvidia needed something else: control. Nvidia never had to build the best laptop in the world. It only had to make sure every laptop worth buying ran on its products. It also had to ensure that nobody else owned a single piece of it. So it built the whole thing itself. Nvidia designed the graphics and the AI hardware, it partnered with MediaTek on the processor, TSMC manufactured the chip, Microsoft shaped Windows around it. Before a single laptop reached the store shelf, everything had already been decided. And that left companies like Dell, HP, Lenovo, and Asus in a strange position. They're the companies you actually buy from, but all they got was the same finished module. They design the case, the cooling, the battery, and the ports. They load Windows onto it and they ship it. They don't own the processor, the graphics, or the AI software that decides what the machine can do. The brands on the lid are just the people who assembled the box. Nvidia keeps around 75 cents of gross profit on every dollar it sells. That's almost unheard of for a company that makes physical hardware. The companies assembling the laptops live on a few percent. The rest of the value is gone before the device ever leaves the factory. So every time more units ship, the imbalance grows. None of it shows up in the price tag, but it decides who holds the power. There's another element to this power shift. Almost every major AI system on Earth is built on Nvidia's software platform, CUDA. And once your tools are built on CUDA, switching becomes almost like starting over. Nvidia even tried to expand that control further, attempting to buy ARM, the company behind a rival processor architecture, in a $40 billion deal. Regulators shut the move down, so instead of owning the rival, Nvidia made its ecosystem the default, and the industry just adjusted around it. It's the exact move the companies pulled before. With graphics cards, it absorbed the value that used to be shared across everyone building them. Now it's running the same play on the processor, the last major part of the PC it didn't already control. A shift like this only works if there is nowhere left to go or backup platform. Microsoft handled that next part. Your current laptop may already be locked out of the future, and you'd have no way of knowing it from the screen. To run Windows' new wave of AI features, a computer now needs a dedicated AI chip rated at least 40 TOPS. That's the measure of how many AI calculations it can process every second. It also needs 16 gigabytes of memory and 256 gigabytes of storage, specs that many older machines don't meet. Cross the threshold and the features switch on. Fall short and they just disappear into a cloud or don't run at all. These aren't minor additions. It's things like live translation while you speak, image generation on your device, smarter search options, and a memory that can look back through all of your work. None of it works without the hardware Microsoft demands. When the requirements were announced, the chips that met them were ARMs, not Intel's. So the entire industry began shifting toward ARM, the same foundation Nvidia and its partners were already built on. The timing wasn't subtle. Microsoft ended all support for Windows 10 in October 2025. That alone pushed a huge wave of people toward buying something new, whether they wanted to or not. The result was the Great Refresh, the biggest forced hardware swap the industry had seen in years, and the machines that clear the bar most comfortably are the ones built on Nvidia's design. Older programs written for x86 don't run directly on these new chips. Windows translates them on the go, through a layer called Prism, so they still open. They just run slower and they never get the full power of the silicon underneath. The old software works as a guest. Of course, RTX Spark sails past Microsoft's benchmark. The baseline is 40 TOPS and Nvidia says this chip reaches over 1,000. That's more than 20 times what Windows asks for. And that's the point. The chip isn't built to barely meet today's features. It's built for what comes after them. Everything below that line is already behind. At that level, the chip can run AI models too large for a normal laptop and keep an assistant running continuously, even when you're not at the keyboard. Once most new software is built for that higher level by default, upgrading stops being optional. These kinds of new computers never fully stop. The AI assistants are partly awake, waiting for something to do. Some systems are even designed to keep working overnight, finishing the long tasks while you sleep. That comes at a cost. How much has been heavily debated. The International Energy Agency and repeated by the Electric Power Research Institute in 2024 put a single AI request at around 2.9 watt-hours of electricity, compared to roughly 0.3 for a basic web search. That's about 10 times more. So the billions of queries each day could work out at nearly 10 terawatt-hours of extra demand a year. Other researchers disagree. The research institute Epoch AI, along with OpenAI's Sam Altman, say the real figure is much lower. Newer models, they argued, had cut a typical request back down to about the level of an ordinary search, so the cost per question is falling fast. But how often we ask is rising. There's an old idea in economics that when something becomes cheaper and easier to use, people don't use less of it, they use more of it, and the total rises anyway. An assistant that takes no effort to summon gets used constantly, even for the small tasks you'd have never bothered a computer with before, so the cost isn't sitting in some distant data center that you never think about. It is sitting in your lap. The machine runs hotter, the fan kicks on more often, the battery that used to last all day starts asking for a charger by mid-afternoon, and the effects show up elsewhere. Microsoft's own emissions have risen by nearly 30% since 2020, driven by the data centers powering these systems. The more capable the software becomes, the more electricity it burns in the background every time you use it. It's a problem every company ran into at the same time. A traditional processor is great at following rules. It goes through instructions one at a time in order, making a clear yes or no decision. That was perfect for everything from a spreadsheet to flight booking, where each move waits on the one before it. Modern AI doesn't think in clean steps at all. It works by guessing. It runs staggering amounts of basic arithmetic across billions of values to land on the answer that fits the best. Every word an AI writes sets off another round of that weighing, with billions of numbers checked at once. A single short answer can take trillions of those tiny sums. There's no neat line of logic to follow, just a huge cloud of maybes resolved in an instant. Work like that rewards a completely different kind of processor. You don't want a single processor solving problems one by one. You want thousands of small workers doing the same simple calculation at the same time. A traditional processor doesn't disappear. It just becomes the coordinator, handing the work off to a much larger AI section and handling the small tasks that still need strict order and precision. Running thousands of those calculations in parallel instead of a few in a line is what makes it all fit on a laptop instead of in a warehouse. And once the machine does the reasoning, the person who used to do it starts to change as well. For decades, using a computer meant knowing where things were. You opened a program, you dug through folders, you clicked menus, and you set things up for yourself. The assistant on these new machines is built to make all of that disappear. Give it enough time, and it remembers yesterday's work, picks the right tool to complete the task, and hands back a finished result. By the time you even sit down, the assistant may have sorted your messages, drafted the easy replies, and lined up what it thinks matters next. The desktop full of windows you once had to navigate becomes something handled in the background. You don't lose control entirely, you can still reject a step. What disappears is the visible control that defined the old era. Knowing where the files are, knowing what's running, knowing why the machine is doing what it's doing. The chip doing the thinking was always a sealed box that no one could look inside. Now the way you talk to it is sealed too. The understanding that people built about how their computers work becomes less and less necessary. And a skill you don't use is a skill you stop remembering. A laptop bought in 2024 or early 2025 is already a relic. Open it up and you can still see how it runs. You can change the settings by hand. You can edit the files that control how it behaves. It belonged to you and it answered to you. All the work an RTX Spark chip does happens inside a sealed box. Its entire reasoning is built on a series of odds, not fixed rules. The software is owned by the duopoly of Nvidia and Microsoft. You give it a goal and the assistant acts. The desktop is still there, just for older programs. It's no longer where the computer actually runs. There's no easy way back to the old model. Software gets written for the hardware that runs it the best. Users follow the software. Older machines fall behind and become redundant. The era of the personal computer as a general-purpose tool owned and operated by its user is coming to an end. What replaces it is a system where intelligence and access depends on what your machine can run. And no one outside Nvidia can fully see how it produces what it produces. The real divide isn't technical, it's access. Who gets to think with it, and who gets left behind. Nvidia and Microsoft are starting to corner the entire market, and that affects your ability to afford what goes inside your computer. An AI takeover is inevitable, or at least that's what you've been told. Once you upload a photo or a voice note, it's gone forever, scraped into AI systems feeding an insatiable hunger for data. But what if that is not the full story? Right now, a digital insurgency is taking place. Traps are being laid inside the data these models depend on. Researchers have figured out how to lobotomize AI models using just a handful of modified JPEGs. And it works. So what happens when the scrapers don't just learn from the internet, but start breaking because of it? Let's say someone types a simple request into an AI model. They ask for a photorealistic dog running through the park. It's the kind of thing a competent model nails every single time. But this time, the results are different. The legs don't connect properly. Extra joints appear where they shouldn't exist. The face subtly drifts into something that's from the uncanny valley. The fur loses structure and definition. It looks like something that has seen a dog 1,000 times, but it doesn't actually understand what it is. And that's the work of a poisoned AI model. It's not a bug. The model is still doing what it was trained to do. The problem is what it was trained on. A poisoned AI model is what happens when someone messes with the dataset it learns from. They slip in manipulated or misleading examples during training so that the model starts picking up the wrong patterns. No one has to hack anything or break into the system. Artists and creators simply post their work online, like they always have. And then the scrapers arrive. These are automated bots that crawl the internet, scooping up massive amounts of images, text, and audio from websites. They don't understand what they're gathering, they just vacuum it up to build training datasets for AI models. That's where the problem starts. Mixed in with all that normal content, poisoned examples get collected too. Nothing looks wrong at the time. The trap only reveals itself later during the next training run. A team at the University of Chicago put that theory to the test. They fed Stable Diffusion about 50 altered pictures of dogs, and then they put the AI model to work. Almost immediately, the images were warped. Every single one had something wrong with it. The team kept going. Once they got to around 300 poisoned images, the model started producing images of a cat. The model trains on billions of images, but for any single concept, say a dog, it really only relies on a few thousand of them. Corrupt a small slice and it all starts to fall apart. You don't need millions of bad files, you need less than 1% of right ones, aimed at the right concept. These models aren't isolated, they are powering Midjourney, DALL-E, and the image tools built into your phone. So if one system becomes corrupted, the effects don't stay contained, they spread. It's the opening shot of a new kind of fight, and the people doing it aren't rival labs or bad actors. They're illustrators, photographers, creatives, and ordinary users with a free app, and they all have a reason to be furious. But before we go any further, imagine this. You're online every single day. You check your email, open a few apps, look things up, stream videos, maybe even do all of that while traveling. And to you, that feels totally normal. But behind the scenes, your internet provider, advertisers, network admins, and sometimes even governments can build a surprisingly detailed picture of what you're doing online. Now, to be clear, no VPN can protect you from everything. You still have to be smart online. Don't click suspicious links. Don't hand over personal information to sketchy emails, and definitely don't trust the so-called Prince of Nigeria. But a good VPN is an important layer of privacy, because privacy shouldn't be something you only think about after something goes wrong. It should be the default. And that's exactly what Proton VPN is built for. Proton VPN helps keep your browsing private wherever you are, whether you're at home, traveling, or just trying to stop your online activity from being tracked. Their no-logs policy has been verified by independent auditors, and Proton is backed by a foundation dedicated to privacy, transparency, and user rights. Proton VPN is also fully open source, meaning its code is publicly available for inspection. So instead of just asking you to trust them, Proton gives people a way to verify what they're doing. And privacy doesn't have to mean slow. Proton VPN offers high-speed connections with VPN Accelerator plus NetShield, which blocks malicious ads and trackers before they ruin your browsing experience. It also gives you more freedom online. You can connect through servers around the world, access content more securely while traveling, and use it for streaming, gaming, and P2P file sharing, all while keeping your online activity more private. So whether you're trying to stop advertisers from following you, keep your browsing private from your ISP, or just take back control of your online life, Proton VPN makes privacy simple. Click the link in the description or go to protonvpn.com/theinfographicshow to get up to a 70% discount when you sign up to Proton VPN's 2-year plan. Nobody poisons their own work for fun. They do it because they felt like their work was taken from them. That feeling doesn't come from nowhere. It all started with a theft. For years, the firms building these models treated the open web as a warehouse. They scraped billions of images, voices, and paragraphs from it. The original creators were never asked, and they were never paid. It was a heist, plain and simple. Much of that haul went into one open dataset called LAION-5B, which held a massive dataset made up of 6 billion images and accompanying text. Stable Diffusion learned from it, and so did most of the art that followed. It was a compressed version of the visible internet folded into something machines learn from. Then the artists started paying attention. They started recognizing their own work in the output. Styles and techniques that took decades to develop were being reproduced in seconds. By 2023, a generator could mimic the brushstrokes and the talent of an artist in a heartbeat. A career's worth of experience was reduced to a prompt and undercut by a tool that cost nothing to use. Conceptual artist Carla Ortiz, along with other artists, sued Stability AI in 2023. Getty Images filed its own case around the same time. The lawsuits dragged out, and all the while the scraping continued and the models improved. The companies behind the models freely admitted to their practices. OpenAI told the British Parliament that building today's top models without copyrighted work would be impossible. Sure, there were opt-out forms, but it put the onus on the creator. Instead of asking permission up front, artists had to hunt down the models, file requests one by one, and then hope they were honored. The balance of power remained with the developers. So the artists adapted. Ordinary uploads turned into weapons, one file at a time. In 2023, the University of Chicago released a program called Glaze, and it was aimed directly at the AI models. Type in an artist's name into an AI model, and it'll generate a painting based on that particular style and the data it's learned on. Glaze changes that. It works by exploiting how a computer sees an image. To an AI, a painting isn't really a painting at all. It's a series of numbers that make up the style and structure. Glaze distorts the numbers slightly. It's subtle, something that isn't visible to the human eye, but the machine learns from the cloaked information. It works like an optical illusion. Two viewers can look at the same image and see completely different things. In this case, the viewers are you and the machine. You see your painting exactly as was intended. The model sees something else. An oil painting might seem like it's in charcoal. A watercolor might be seen as completely different medium. The visual style that the scraper came to learn from has effectively been moved. Word spread fast, and Glaze has now passed 6 million downloads, but there are limits. Glaze could hide a style, but it couldn't stop someone from taking the image itself. And every time people found a new way to alter the image, scrapers came back with better ways to recover it. It was like playing defense forever. The creators needed something that could end the fight. They needed a poison pill. It came in January 2024, and it was Nightshade. Another product from the University of Chicago, it had one goal: to infect. An image run through Nightshade will look completely normal to both human eyes and the machine. But it's like a Trojan horse. If a machine is trained on that one image, the model starts learning nonsense. The results are almost comical. Hats turn into cakes, handbags into toasters, and a car's learn to be drawn as a cow. For artists and creators, it felt like payback. For years, AI companies had scraped artwork to train their models. Now the very thing being taken could be turned against the people taking it. The demand was instant. Nightshade hit 250,000 downloads in just 5 days. University servers buckled under the traffic. The team behind it had to scramble to post backup download links as thousands more rushed to get it. Most people assumed this was a form of hacking. It's not. No firewall gets breached, and the tool never touches a single company server. Researchers call it adversarial machine learning. But a simpler way to look at it is that Nightshade is a magic trick for the machines. The model isn't attacked from the outside. It is fooled into teaching itself the wrong thing, and then it trusts that mistake as if it were true. It doesn't take much to start the process. Fewer than 100 carefully crafted images can be enough to poison a single concept inside a top AI model. And if you pair Nightshade with Glaze, that same image can hide an artist's style and poison the training data at the same time. But those results came from models researchers could test directly. The bigger AI systems are harder to study, and nobody outside those companies knows exactly how vulnerable they are. But that is not really the point. Nightshade took the idea from a theory on paper to something that actually worked. The damage doesn't stay contained either. Poison the concept of a dog, and the related ideas like huskies, puppies, and wolves can start drifting with it. In some tests, researchers fed hundreds of corrupted images in a single model until it could barely generate recognizable images at all. And that's where this stopped being purely defensive. Every poisoned image uploaded to the internet becomes a potential sleeper cell. It can remain unnoticed inside a dataset for months or years, waiting for the next training run. The person who uploaded it might never even know if it was collected or which model eventually learned from it. Images were only the start. The same trick works on anything a machine learns from your writing to your face. And your voice is the next target. A service like 11 Labs needs only a few clean sounds of your voice to build a convincing copy. A podcast clip can be enough. So can a YouTube video, a few seconds of footage on social media, or even an old voicemail buried in someone's phone. It's become a favorite tool of scammers. And it isn't a hypothetical risk. In 2024, criminals used cloned voices and faces to steal about $25 million in a single faked video call. Banks and law enforcement agencies now warn people about calls from cloned relatives asking for money. A tool called Safe Speech was built by security researchers for this exact reason. Your voice has its own signature, a kind of audio fingerprint that AI systems use to recognize and copy you. Safe Speech subtly smudges that fingerprint. To another person, you sound exactly the same, but to a voice cloning model, you become much harder to copy. To the machine, it works a bit like radio interference. You hear the voice clearly, but the AI doesn't. The details it needs most get scrambled. Train a voice clone on that recording and the results come out wrong. They're close enough to sound human, but missing the subtle traits that make you sound like you. The timing is what makes it clever. This isn't a filter slapped onto a fake after it's generated, it's in the original recording itself. The AI learns from the protected version, which means the cloning process breaks before it ever succeeds. There is no clean copy for the model to learn from. That's what makes this different from protecting artwork. A stolen portfolio is one kind of loss, your voice is another. It's the sound your family and friends recognize instantly, the thing a scammer wants the most when they're trying to impersonate you. It turns the tables. The target gets to set the trap. For the first time, artists, writers, and everyday people had a way to fight back against systems trained on their work and identities. It sounded like the next step in digital security. And then the AI labs responded. They weren't about to lose access to the data that fueled their models. If artists could poison the training set, the labs would try to remove the poison. And that kicked off something bigger than a security tool, an arms race. They couldn't just accept corrupted datasets, and they couldn't afford to throw most of them away either. So they tried a straightforward fix. They began checking each scraped image against its caption, and then they dropped anything that didn't match. In theory, poisoned data should stand out. In reality, it only catches part of it. Tests on these systems show it flags maybe 40 to 60% of poisoned images. The rest slips through. And then there's a second problem. It also deletes plenty of clean data, leaving the model with either contaminated data or not enough to learn from. So they tried something else. They started scrubbing every image through a cleaning model before training, trying to wash out anything suspicious. It sounds clever, but it's slow and expensive. And it still has limitations, because the poisoning adapts. Artists design it to survive that cleaning step, so it reappears on the other side like a stain bleeding back through. Not long after Glaze launched, one research group said it had already broken through the cloaking, so the Chicago team pushed out a tougher version. Whenever the program was breached, they developed a new patch. It was a war of attrition. Even if a voice has protection built in, there are still ways to strip parts out of it. Push it through enough processing and some of that protection starts to fade. In some cases, it gets noticeably weaker, not gone, but damaged enough to matter. The poisoners are winning for now, and the reason is lopsided. You have small teams constantly trying new tricks in the open. On the other hand, a handful of AI labs are trying to patch holes as they appear. So every time a lab rolls out a fix, it gets tested immediately, and almost immediately a new version shows up, adjusted just enough to get around it, usually within weeks. And this all comes with a price tag. It doesn't land on the labs first, it lands on the people training the models with the data. The whole AI business model was built on the promise that the data would be free, endless, and clean. The poison breaks the idea of clean. Once that goes, the other two stop feeling true as well. Because now nothing can be trusted at face value. A poisoned file looks identical to a real one. There's no label or warning, so every dataset turns into something that has to be checked manually or with tools that still miss a lot. Training a top model already costs hundreds of millions of dollars, and every extra cleanup step adds to that bill. A single poisoned batch can set a project back by weeks. And that's the point. The goal was never to wreck one model for fun. It was to make stolen data more expensive than paid data. There's already a legal, cleaner method being used. Adobe trained its Firefly tool on Midjourney images, Shutterstock on similar deals. If you want clean, quality data, you need to pay for it. That is a serious problem for the industry. Investors poured tens of billions into AI on a single bet that the data would stay cheap forever. That bet isn't looking like a sure thing anymore. For a long time, the belief was that if you created something, you own it. The scrapers tore that deal up without asking anyone. The AI companies act as if human work was free, endless, and owned by no one. That was the original mistake. Paintings were scraped, photos were downloaded, voices, faces, videos were collected in huge amounts. If it was online, it was fair game. Consent seemed optional. In every other industry, the opposite is the standard. A photographer licenses an image before a brand uses it. Musicians clear samples before a track goes live. Even film studios pay for every frame of stock footage they use. The work of millions of people got treated as if it belonged to no one. This battle wasn't created by the artists, it was the AI labs and their trainers. The moment work was taken without asking, the balance changed. Everything after that was just a reaction. You can't build an empire on the idea that people do not count, and then act shocked when those same people fight back and question how the system works. Because the problem isn't sitting in a contract or on a policy page, it's built into the way the models learn in the first place. Every safeguard before this tried to politely control behavior through copyright notices or opt-out forms, but none of it really stopped the scraping. This is different. For the first time, a single person can influence what the system learns next, and the system doesn't get to ignore it. With people turning the tables on AI scrapers, digital theft is getting harder, especially when it comes to scams. We're witnessing the biggest rug pull in tech history. AI tokens are supposed to be getting cheaper thanks to technological breakthroughs and efficiency. But as of March 2026, OpenAI is losing roughly $1.22 for every dollar of revenue it makes. Venture capital is keeping prices artificially low while companies get hooked on the API. The end game is brutal. Either the AI startups go broke, or you do. Internal records leaked to the press in early 2026 show OpenAI is in trouble. The company spends far more than it takes in. The burn for 2026 lands somewhere between $17 billion and $25 billion cash. Meanwhile, revenue reaches between $13 billion and $20 billion. OpenAI is losing money on every dollar it earns. The losses are not a one-off. By the company's own projections, they'll add up to around $115 billion by 2029. Profit is not expected until close to 2030. You can't lose money on every sale forever. Eventually, something has to give. Prices go up, or costs are cut, or the business folds. It's not limited to OpenAI either. Y Combinator is the startup accelerator that helped to launch companies like Airbnb, Stripe, and Dropbox. By most estimates, roughly 58 to 67% of its winter 2024 batch were AI startups. Most don't own the model they're selling. Their business is built on top of someone else's technology. The industry calls them wrappers. Their costs are set by whoever owns the model underneath them. Their entire business depends on those prices staying low. But the companies setting those prices are already losing money. That means today's prices may not be sustainable, and for thousands of AI startups, that's a problem. Months or even years of work can disappear in a single billing cycle, not because the product got worse, but because a supplier changed a number on an invoice. Much of the AI industry is built on top of the same handful of model providers, so when one supplier raises prices, the whole field feels it. It wouldn't be a slow death, it would be a matter of weeks. The entire AI boom was built on a gamble. Lose money today, dominate the market tomorrow. The assumption was that scale would eventually fix the economics. But what if it doesn't? This business model isn't new, it's called a loss leader. You sell below cost, you attract customers, and you worry about the profits later. The aim is to become impossible to leave and to have the customer base hooked onto your product. For a stretch in 2023 and 24, AI tokens were priced at pennies, far below what they cost to produce. For a developer, the choice was obvious. Nothing else came close on price or power, so the whole world built on these models. They became a default, the way electricity or cloud storage had before them. But renting intelligence is different. Your power company can't read your meter, learn your habits, and then sell them back to you. An AI provider sitting under your product can do exactly that. Once enough companies were hooked, the terms began to tighten. A business might spend months shaping a model around its own private data. That tuned model can't just be boxed up and carried somewhere else. The prompts and the data all live on servers it doesn't own. Leaving means ripping all that up. AI contracts became hostage deals. Staying costs a fortune, leaving costs even more. The provider can rewrite the terms almost whenever it likes. When OpenAI retires a model, every company built on top of it has to adapt. Code that worked yesterday needs to be rewritten tomorrow. Entire products can find themselves racing against a deprecation deadline that they never chose. While startups are taking that risk, AI giants are taking risks of their own. In late 2025, OpenAI committed roughly $250 billion to Microsoft's cloud infrastructure, and then it signed a second giant deal with Amazon worth tens of billions more. This isn't a company spending money because it's found a profitable business model, it's spending money because it needs more compute to keep the AI race going. In April 2026, Microsoft and OpenAI rewrote their partnership, and the new terms set OpenAI loose. Its Microsoft license stopped being exclusive, so it can now run on any cloud it likes. It's even building its own chip with Broadcom. Suddenly, OpenAI bought itself more room to move, and with it, control of the layer that everything now depends on. We've seen versions of this before. Ride-hailing kept fares below cost until subsidies faded and prices rose. Streaming did the same thing with content, but AI is harder to escape. If a ride gets expensive, you just switch apps. If a subscription changes, you cancel it. But if your product is built on top of a model, you don't switch, you rebuild. Most companies can't rebuild fast enough because they didn't just build on the system, they built into it. Large-scale AI systems run on physical infrastructure with hard power limits. A training cluster with around 20,000 Nvidia H100 GPUs pulls about 20 megawatts non-stop. A smaller cluster of 10,000 chips runs somewhere between 10 and 15 megawatts. To put that into context, that's enough to power 15,000 average American homes all at once, day and night. And that's just a single cluster. The biggest companies run multiple versions of them. Every answer you pull out of one of those systems draws power off the grid. It also wears down chips that cost tens of thousands of dollars each and age out within months. 20,000 of them can run past $500 million in hardware alone. The moment they switch on, they begin losing value. For a while, engineers tried to push costs down, and for a while it worked. But you can't just write code that beats the laws of physics. Power costs money. A chip wears out in its own time, no matter how clever the software around it is. The numbers reflect that grim reality. These clusters have to be running almost every hour, because an idle chip means a loss. Tech firms pay rising power bills. They write off the hardware fast because the next chip makes the current generation look obsolete. Put all of that against what providers actually charge, and the charge does not come close. It was never supposed to. The low price was bait. These companies are not bleeding cash by accident. They are doing it on purpose. Investor money has filled in the gap between costs and price, but that gap keeps widening. That cheap price tag is actually just an illusion. Cash can push the price below cost, but the power bill doesn't change. When the investor money runs out, there's only one option left: the price charged to the customer who can't leave. And that's why AI companies try almost everything except charging what it actually costs. The workarounds buy some time, but they distort the market. When an AI company that builds the model also decides to sell it directly to customers, the effects show up quickly. The clearest example is a company called Jasper. It built an AI writing tool directly on OpenAI's models, and for a while it was a successful business. Revenue climbed past $120 million. Investors valued it at $1.5 billion, and more than 100,000 customers signed up. Then, ChatGPT arrived and it was virtually free. It did much of the same work for a fraction of the price. Jasper's growth suddenly went in reverse. By 2025, its revenue had fallen to around $88 million. The company survived, but by pushing hard into corporate marketing and finding firmer ground. It's a bit like a building full of chefs. Each one rents a small kitchen upstairs and cooks for their customers. And then one morning, the landlord opens his own restaurant in the lobby. It's the same dishes, but given away for free and using the same recipes that he learned by watching his tenants work. If your only advantage is access to a model owned by somebody else, you don't really have an advantage at all. Not when the model's owner just decides to compete directly. It's a move known as Sherlocking. It comes from an old Apple habit of swallowing up the best features of other apps into its own software. The provider watches how people use the tools built on it and then finds the most valuable uses and folds them in. The original maker is quickly undercut and out of business. A startup spends years polishing its prompts and workflows. Soon that work shows up inside the platform copied for free. Its edge evaporates, its pricing power follows, and its biggest contracts slip from must-have to maybe. And this is why relying on a single vendor has climbed the list of corporate fears. It used to look like the smart, fast choice. After Jasper, it looks more like a loaded gun left on the table. But eating your own customers still doesn't balance the books. All you gain is a smaller group of rivals. So the providers try something else, a move that doesn't touch the companies on top at all. It touches the product itself. On the surface, token prices keep falling, and every press release calls it progress. But beneath those announcements, something might be happening to the thing you actually pay for. A large, smart, expensive model can be diluted into a smaller and cheaper one. Shrinking a model can be fair, useful engineering. Done only to protect profit, it becomes a swap. And it has the same label, but the product is thinner. The new version is tuned to stay just good enough that you don't cancel, yet it is cheap enough to save a fortune across billions of prompts. The decline rarely is visible itself. The model forgets just a little bit sooner, reasons a little less deeply, and dresses up its guesses as creativity. Because the price keeps dropping, people see the whole thing as a win. Frontier models are still growing, and shrinking them into highly capable systems represents massive technological processes. But that steady drift towards smaller and cheaper points the other way. It hints that the numbers never really added up. Time is the only thing this really buys. The hostage contracts, the Sherlocking, the shrinking of the models, none of this is a real plan to solve the issue, because the problem lies elsewhere. Software was supposed to be the perfect business. You build it once, you sell it 1,000,000 times, and each extra copy costs you almost nothing. That promise built 20 years of sky-high valuations. It's baked into every pitch that called AI the next great software story. Silicon shattered all of that. Thanks to all the costs associated with AI, OpenAI's margin was close to 33%. A healthy software business operates at 70 to 80%. So OpenAI got desperate. It began selling ads inside ChatGPT. The pilot launched in February 2026. Within 6 weeks, it was on pace to make $100 million a year with over 600 advertisers on board. Sam Altman had spent years calling ads a last resort. Now the most famous AI company on Earth is renting out your attention. Rival company Anthropic mocked the move. But mockery doesn't cover a $25 billion bill. HSBC analysts have estimated that OpenAI will need $207 billion in fresh funding by 2030 to cover data center and compute costs. Sam Altman, meanwhile, has promised $100 billion in revenue by 2027. The gap between those figures keeps widening. What comes in and goes out are moving on very different trajectories. In late 2025, Altman said OpenAI had lined up about $1.4 trillion in compute deals over 8 years. The company made roughly $13 billion that year. One investor questioned the numbers on a podcast, which led to Altman offering to buy his shares. Just months in early 2026, the plan changed again. OpenAI told investors the real target was closer to $600 billion. Even the scale of the ambition had to be rewritten. When a plan is revised downward by more than half, it stops looking like strategy and starts looking like constraint. Patience is beginning to run thin. The latest funding terms require a clear path to profitability, something the cheap access era never had to prove. The timeline is tightening as well. With an IPO in sight, OpenAI can't afford more losses. Public investors want profit, not promises. Neither is falling fast to save the current business model. No amount of code removes the need to run massive clusters of hardware that must be replaced long before they've paid for themselves. The industry assumed software margins would eventually outrun infrastructure costs. But so far, that hasn't happened. That leaves a simple constraint: keep prices low and burn through cash faster than it returns, or raise prices and bleed users who made the system valuable in the first place. Either path arrives in the same outcome. The only uncertainty left is how many players are still in the game when it does. When the price is reset, the companies still standing will be the ones that control their own models. There's already an alternative emerging. Open models can be downloaded and run on hardware users control. Meta's Llama is freely available. DeepSeek has shown that capable models can be trained at a fraction of the expected cost. They are good enough to run a real business on. Whole teams already run them on their own servers with no outside key and no surprise invoice. The trade is straightforward. Customers take on the headache of running the software and the headache of running the hardware, but they stop being held hostage. At scale, this can be considerably cheaper than renting models and infrastructure. But there's a bigger advantage. Customers have control. They own their data. They decide when the model changes. The great shutout is already beginning. The smallest wrappers will fold quickly after the first real price change. Mid-sized firms will scramble for tools and engineers they should have hired earlier. And at the top end, only the biggest players will end up running serious models on their own. For everyone, it stopped being about saving money. It's about staying alive. Leaning onto a single provider for your core income is a massive risk. One decision in someone else's office can cut you off completely. The companies moving fastest are already building their own clusters and tuning open models on their private data. They're pulling their most sensitive work back in-house. Owning also means a bill you can predict. Renting means a number that can leap in any given month. Owning means a cost you can plan around for years. For most businesses, that beats any discount. A split is forming, and within a few years it'll be obvious to see. On one side will be the companies that treated cheap tokens as a permanent gift. They built their whole cost structure on top of them. They are the tenants, and they will learn the lease was never really theirs. On the other side are the companies that treated the cheap years like a window. They used it to get started and figure out what worked. They were able to see the escape route. The difference between the two groups isn't money or talent, it's timing. One side saw falling prices and they assumed it would last. The other saw borrowed time. Either you control the hardware your business runs on, or you let a company that must squeeze you set the price. Waiting carries its own price. The longer customers stay, the harder the eventual fall. The cheapest moment to leave has already passed. The next cheapest moment is right now. Tokens were never getting cheaper because the technology had set itself free. They were cheap because someone else was covering the bill. And that bill is due.